have come down for the first time in 6 months. The average house price dropped 1% to just under £290,000 in the month of March. That follows a 0.3% gain in February and slight increases the previous 4 months. The market appearing to respond to a dip in mortgage costs and the expectation that interest rates will fall later this year. Mortgage approvals surged in February to the highest level in 17 months. BlackRock unveiling new incentive awards as part of its succession planning. The world's biggest asset manager announcing its COO and global business heads each received $8.5 million in performance-based stock options. The incentive pay plan was approved for, quote, a select group of senior leaders who we believe will play critical roles in BlackRock's future. In total, BlackRock says it handed out a total of $120 million of the stock options. And Samsung sales missed forecasts in the first quarter, but preliminary operating profit rose sharply, ending a string of quarterly declines. The results underscore how demand is starting to rebound for memory chips that power electronics after a severe downturn in the industry. Plus, the Wall Street Journal reporting Samsung plans to raise chip investments in Texas to about $44 billion. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, Argentina's big inflation problem.
Today, wages are miserable, not through our own fault. That is due to 20 years of populism.
More on that exclusive conversation in just a moment. Live from New York City, this is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Disney invented a way you can walk for
100. Looking for a number. Based on our survey, the median estimate, a number around 200K. That data drops in about 43 minutes' time. Yields are higher by 2 basis points, 432.95 on a 10-year, and crude near the highs of the year, just backing away a touch, 86.49. Under surveillance this morning, Argentina President Javier Milei facing an uphill battle. The country suffering triple-digit inflation and its 6th recession in 10 years. In an exclusive conversation with Bloomberg News editor-in-chief John Micklethwaite, he details his ambitious reform plans.
But still, and despite the put options and the interest-bearing liabilities, what we inherited from the previous government, and after having bought almost $12 billion, what we have sterilized through the purchase of the propelling, and as regards the fiscal surplus, the money base hasn't changed. So we are cleaning up the balance sheets of the central bank, and in so doing, the long-term price level shrinks because we are shrinking the nominal scale in the economy, and the slope is reduced and the inflation rate comes down.
my general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
From his party in Congress, and secondly, because I think there is a limit to how much pain Argentines can take. The inflation rate here is, he's reduced it to 13% a month. It's still unbelievably high, and people's savings, people's money is disappearing regularly.
John, what do you notice is the difference between the man on the campaign trail, the big plans he had, and what he's been able to execute so far in the first few months?
Well, he's kind of calmed down a bit. on the campaign trail, he called China an assassin. When I asked him about China in this interview, he sidestepped that a bit and said they had to get on with people. I think Lula and the Pope, he both called them communists. He calls the people who run the Congress, he talks about the caste. He runs very much on a somewhat kind of Trumpian, I'm against the establishment way of looking at things. But the fact is he has to get some kind of deal through Congress. He has sent in an enormous series of reforms which Congress shoved back at him. Now he's trying to go through to the governors. But to give you some idea of how much he's thinking of taking out, at the moment the Argentine state is around 37% of GDP. The current set of reforms he's sent to the governors are reducing them to 22%. This is kind of Thatcherism on steroids. It's much bigger, much more dramatic, and the only thing he's got going for him, I think, is the fact that Argentines have had 100 years of false dawns, false promises, all those things. This used to be, I think, the fourth richest country in the world just over 100 years ago, and it has gradually gone down. He is promising kind of honesty and truth, but that's very difficult if you've just seen your pension reduced by 30% in a year. It's a very tough series of proposals he's trying to push through.
John, you mentioned China. How is he grappling with the reality of dealing with China as opposed to the plans he had?
Well, in theory, he's very against China because he hates socialism and he hates, again, he called them assassins. But, you know, the basic fact is he has an $18 billion swap line with China, and he has virtually no other reserves. So that, I think, exercises some degree of caution on him. There's a kind of row here at the moment to do with the space station, which the Chinese are building down in Patagonia, which sadly I didn't get to visit. But they're building it there, and the US is saying, look, this is a military purpose. And there's a sort of, that was sort of an opportunity for Milei to say, no, I'm going to close it down for you. It's sort of obvious at the moment that he's unlikely to do that. And so he's having to, he's having to deal with it. We've got a long, big take about this today. You have this man who's come in really advocating exactly the obvious opposite of everything that China is. But he's having to make compromises. And one rather weird part of it is actually the Chinese are no longer investing quite so much in Latin America as they did. But Argentina is unusually on the hook to them. So they have dramatic degrees of leverage here.
John, an absolutely fantastic exchange. Fascinating stuff with one of the biggest characters in international politics and one of the biggest experiments taking place right now in international economics. Coming up very shortly, Nadia Lovell of UBS. We'll catch up with her, head of payrolls, 34 minutes away.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit, how can we really tap into new things, continue being disruptive. We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So
I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
This is Bloomberg.
The jobs market is showing that there's resiliency.
That's probably going to be the most critical piece of data that we're going to be looking for at that report is what happens with the average hourly wages.
If those wages tick up or stay sticky at 4%, then we'd have to adjust our expectations for the Fed.
There is more resiliency in the labor market. The economy continues to power forward.
This labor market, John, is just amazing. If we see a 213 or a 250, I wouldn't be surprised anywhere in between, which definitely demonstrates a very resilient labor market.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
This is it. This is what we all get out of bed for. It's payrolls, 30 minutes away. At least some of us do. Anyway, 214,000 on payrolls is the estimate. The median estimate, 214. The previous number, 275. All eyes on this one as this market has been whipsawed from equities to bonds to crude over the last week.
And really, Priya Misra set it up perfectly. How many bumps can we tolerate before it becomes something that is stickier and that we have to take seriously? She's pointing to average hourly earnings, aside from just the benchmark number. How much do we start to see a resurgence in just how much people are getting paid?
Will we disrupt that supply side story that this Federal Reserve has embraced? Embraced because they don't have to worry about strength in the economy anymore, because that strength won't come with punchy inflation numbers. You get wages starting to surprise to the upside. Do you disrupt that Goldilocks theme in this stock market?
Yeah, potentially, because all of this is inflationary. And I think today's print will really start to show what is the Fed potentially leaning towards. Priya Misra talks about this. She does feel like they're really starting to encompass the dual mandate. They care about both. Jay Powell was asked about this. If you had a crystal ball, which one would you look into? And he really said, you're trying to make me single-minded. We are a dual mandate. But I think today's print can really shed a lot about their path.
Well, the man on the Fed we all want to talk about is not Powell, it's Kashkari. And we've been saying all week, how many friends does Kashkari and Bostic have? Kashkari and Bostic are basically saying maybe one or nothing throughout the whole of 2024. And maybe if you think you're going to get just one, you might have to wait until the end of the year, Q4 2024, before we even do anything. And that introduces all the politics, and that's something they don't even want to talk about.
The data hasn't cooperated. The strength that we've seen so far has really given a lot of people pause about how much the Fed is actually effectuating a restrictive policy. Do we get signs from this labor market report that ongoing strength in the labor market is coming from the bottom up, not just people who are flooding into the country from other places and taking jobs for lower wages, which are driving down the potential inflationary forces and leading to a robust economy? How long can that story keep holding for this Federal Reserve?
Some big debates through the next 60 minutes or so. Let's turn to the equity market. Equity futures near session highs, up by 0.4% on the S&P 500. In the bond market, yields higher by, let's call it a couple of basis points on a 10-year, 432.95. In the commodity market, $86 at about 70 cents on WTI. We're positive there by 0.1% and printing new highs for 2024. With us through the next 60 minutes, we'll catch up with Nadia Lovell of UBS on why she thinks the market rally has more room to run. Former Fed Governor Randy Kroszner on the Fed's path forward, and we'll speak to Mohammed Al-Erin of Queen's College, Cambridge, reacting to the payrolls report from Lake Como, which is highly depressing for us all to see. Why don't we go to that?
Can I just say, Ellen Zentner, her background, she looked like she was coming from Never Never Land.
Right.
And then we started hearing other fairy tales, and I'm thinking to myself, how can you be pessimistic in any way, shape, or form?
I thought when I joined surveillance, we were going to be going to Lake Como.
That's what they told you? That was the trade?
That was the trade.
Not the trade. Not the trade, apparently. Because I thought the same thing. You get to go to Villa d'Este, TK goes with you, and then it stopped happening.
False advertising.
Right.
They roped you in and
twice
then bait
a year
and switch.
as well. They would go twice a year. Better times, good times. Maybe not better, good times. We begin with our top story. The payrolls report 30 minutes away, and stocks are looking to bounce back from yesterday's sell-off. Nadia Lovell of UBS saying this: as we look to the second quarter, we expect the S&P 500 to be well supported by further easing of financial conditions and earnings growth momentum. Nadia joins us now for more. Nadia, it's been quite a journey already through 2024, and it's good to catch up with you. Originally, it was something like 4 cuts, then it was 3. Nadia, where are you at for 2024?
You know, we have been there for some time at 3 cuts starting in June. It's clear that this is a Fed chair that wants to cut rates and is willing to look through some of the hot inflation data. But we do think the recent market fluctuation in pricing is quite reasonable, just given the strength in the economic data. But we think that the easing cycle is imminent. You even have the more hawkish tilted Mesa that's pointing to 3 cuts being reasonable this year. And so that should be a positive for risk assets. You have financial conditions that are much easier than they were last year, and they will get easier later this year. And at the same time, the U.S. economy is growing, and that's what's really important for stocks.
I got a lot of analyst notes overnight worried about Goldilocks' health and feeling like maybe she was on her deathbed or maybe she was really facing some pretty big challenges. It sounds like you're still embracing Goldilocks and seeing that as the most likely narrative. How do you push back against some of the gloom with respect to higher oil prices, inflationary inputs, and the idea that growth could potentially continue, but with some of these other aspects as well?
Yeah, of course, we're closely watching, the pickup in oil prices, just given the implications that it could have for inflation and, more importantly, consumer spending, which we know has sort of been a pillar of strength in the economy as well as for equity markets. But our attention is really shifting to the earnings season, which is upon us, we know, which will kick off next week. And we think that companies will be able to beat the relatively low expectations. I mean, we have, consensus looking for low single digits earnings growth. But if the early reporters, Lisa, are any indication, and historically they have been, we could see earnings growth come in at mid to high single digits. And we could see some upside from the more cyclical areas of the market. Because remember, you have Atlanta GDP now that's tracking at 2.5%, and you'll have recovery globally in PMIs. And then reality is, it's higher for longer interest rate environment should be positive for financials too. And tech is still holding in there from an AI demand. And so we think that the ingredients are there, that even though we might see some, breather here and there, that ingredients are there for the bull market to continue in a healthy way.
We're about 23 minutes away from this non-farm payrolls report. How much are you expecting, or what could you see that would make you change your view on some level?
Well, I think if you see, of course, anything in the low 100s or below that, that will call into question the growth outlook, as we know that, maybe the Fed is too late and we're slowing down faster than expected. Or if you see something, are close to 300, then, of course, people get really concerned again about inflationary pressures. But we know historically what we've seen on Payroll Friday is that the market has knee-jerk reactions, but within a few days, it sort of sorts itself out. And we think that earnings is going to be that differentiator next week.
Nadia, is there anything that you potentially could see that could really shift the Fed in terms of not just no hikes, but potentially having a debate about another rate hike?
I think if you see, upward pressure on wages, we know that average hour earnings tends to be volatile and are prone to revision. So I wouldn't put too much weight on that. We know that the Fed's preferred gauge is ECI. So if we see a pickup in that number, that could give the Fed pause, and if we see continued upward pressure on oil prices, that could also be an issue. But we know that historically what you've seen, the sort of a rule of thumb for a $10 increase in oil prices, that tends to add about 40 or so basis points over a 3-month period for CPI. But the Fed tends to look through shocks, and it's more focused on core. But that could give the Fed some pause if we see continued pressure upwards on the service sides, as well as any sort of a reacceleration on the good sides.
How hard is it going to be for the Fed, even if they want to look through the commodity resurgence we are seeing and the uptick in oil prices, even if they want to look through it, how difficult is it going to be for them to communicate around it, given the fact that we are expecting potentially more strikes and more geopolitical risk coming out of the Middle East?
I think it will be a challenge, and it's a needle that they will have to thread. But our core view in terms of the oil outlook, we don't think that oil prices will be sustained for too long above these levels. I mean, our core view is for Brent to be at $86. And yes, with right now, it feels like about $5 or so are attributed to, geopolitical risk premium. But oil prices, we don't think it will be sustainable above $100, because reality is there is excess capacity right now, particularly coming from OPEC. And we would expect Saudi Arabia to step in and sort of balance the market, and also to protect market share. We know what happened last year when oil prices spiked up. We did see a pickup in production from the U.S. side, and that ultimately led to oil prices moving back down lower. So we think that oil prices will probably come down back towards the $85, $86 range.
Nadia, can we just play a game just quickly and tighten up the time horizon to about 20 minutes? And forgive me for doing so. Stuart Kaiser of Citi just wrote in. He wants to handicap payrolls, non-farm payrolls. This is what he says. A negative read would be under 150K, given other subtle signs of weakness in labour data, or above 250, which would introduce inflation risk, but medium-term good growth is good. Nadia, how would you frame what is good news and what is bad news in about 20 minutes' time?
I would tend to agree with what Stuart has put forward in terms of sort of that knee-jerk reaction and thinking that bad news of under 100 would cause the market to fizzle a little bit and sell off a bit, and anything sort of closer to 300 would cause concerns about inflationary pressure. But again, like I said earlier, I think this will just be temporarily, and earnings over the next month or so are really going to determine the course of this bull market.
Nadia, wonderful to hear from you. It always is. It's going to catch up on Payrolls Friday. Nadia Lovell there of UBS. I love this survey from BMO. I want to share this with you. You might like this one, Lisa. 57% of survey respondents said they would buy if Treasuries fall after the release. This is payrolls in about 20 minutes. If Treasuries rally following the report, around 2/3 of investors said they'd do nothing. Only 19% would sell, compared to a 6-month average of 29%. What does that tell you about just the bias at the moment of fixed income investors?
That they believe that the Fed has their back, and they believe that rates are going to go lower, and that there is a natural inherent bullish tilt generally toward duration. And again, how many bumps do we need to see before that gets shaken? Because right now, that's been holding down the long end from being overly volatile past those triggers of 450, which we were hearing about from Priya.
If the bears capitulated in the equity market, I'm not sure the bulls have in Treasuries. Is that right?
I would guess that they've gotten more emboldened, because ultimately the whole narrative around a Fed put has only become more concrete as time has gone on. And this idea has been, even auctions don't seem to matter. Despite all of the big picture deficit issues, it never has really
Despite how much you try.
I've tried. And people say, keep trying. And then, you say.
Peter Cheer reckons it will start to matter.
Yeah, like
supply dynamics start to reassert themselves, maybe later this year, maybe the back half.
Well, it depends on whether we get a policy shift, whether the election could potentially be that shock.
Precisely. I think we spoke to Eric Cantor a little bit earlier this week, who was the former House Majority Leader about a decade or so ago down in Washington, D.C. And we've been asking this question for a while. At what point does Washington come up with a policy proposal that this market, fixed income, totally rejects? In a similar fashion, and this is what you've been talking about, to what we saw in the UK a couple of years back.
Neil Kashkari kind of leaned on that and said, well, the U.S. isn't going anywhere, and it really still has the fiscal dominance with the dollar, because that ultimately is the question, right? Can we face a Liz Truss moment? Other people say you start to get tariffs, you start to get tax cuts, you start to get the deficits that are already significant, and then you add to that potentially weaker growth. That could be a pretty toxic recipe that could lead to some rethinking.
Treasury yields right now up 2 basis points. Let's call it 4.33 on a US 10-year. Let's get you some stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Mortgage rates rose in the U.S., but just by slightly. Freddie Mac says the average rate on a 30-year fixed loan was 6.82%. That's up from 6.79% last week. Freddie Mac's chief economist weighing in, saying while incoming economic data indicate lower inflation, they do not expect rates will come down meaningfully in the near term. Tesla is heading back to court and it's enlisting the help of Apple. The EV maker is aiming to prove the safety of its autopilot system after an Apple engineer was killed on his commute to work back in 2018. Tesla claims the driver was playing a video game on his phone when the crash occurred and aims to call an Apple engineering manager as a witness. The victim's lawyers say Apple is secretly helping Tesla blame the accident on distracted driving. And Elon Musk is giving away some blue check marks on X for free. Musk pledging to start handing out the feature to people who have more than 2,500 verified followers. Several users noticed this week that the blue check marks have suddenly reappeared on their profile. It marks a change of strategy for Musk, who has criticized the old Twitter's decision to hand out check marks to prominent accounts. That's your Bloomberg Brief. John?
Yahara, thank you. I'm proud to say I'm one of the chosen ones. It reappeared earlier this week.
Yeah, I've gotten some comments on that.
I saw a lot of people sort of the virtue signaling around it, say, I didn't ask for this, who cares? I was kind of happy it came back. Well, I mean, weren't you?
Well, the whole idea is how many bots can it take before suddenly people realize, wait a second, the system isn't working? Because how many bots did you have? I mean, I would get complaints all the time.
Yeah, quite a few.
And then I would try to report them, and they'd never go away. There was one that was verified for a while.
But then Musk trying to make money off the check actually didn't work.
This reminds me of the Sneetches, Dr. Seuss, the people who got stars on their bellies, and then everybody wanted stars, and then everybody got them, and then people wanted the stars taken off. That's where we're at.
We've got a star on our belly. Is that
I
it?
think so. I think that's what it is.
Okay. Up next on the programme, I didn't know about that. The report, just around the corner.
This labor market is just amazing. We continue to see strong numbers. If we see a 213 or a 250 tomorrow, I wouldn't be surprised anywhere in between, which definitely demonstrates a very resilient labor market.
Tomorrow is 15 minutes away. The jobs report, just around the corner.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from New York, 13 minutes away from the jobs report, looking for something in and around 200K based on our survey this morning. Equity futures on the S&P 500, a little firmer throughout Friday so far, up 1/3 of 1%. Under surveillance this morning, the jobs report, just around the corner.
This labor market is just amazing. We continue to see strong numbers. If we see a 213,
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
A strength that we see in the labor market, that far more workers than we had originally estimated, and that would lead to stronger growth. So that would mean that they would probably hold tight for a while.
How difficult, then, is it to forecast a future labor market if, say, we get new immigration policies with potentially a new president?
Well, that certainly would be quite a while off, because even if there were a new president elected in the fall, those policies wouldn't start coming into effect until sometime next year. So it'd be a year from now. And I think the Fed is probably focused on this year at the moment rather than the next year. But it will take that into account in going forward, and they'll do some alternative simulations. They'll say, what if labor market policies are this? What if immigration policies are this? And then try to decide, well, what's most likely.
Do you think it raises questions about whether they truly are sufficiently restrictive?
So that's one of the key questions is, what is the long-run neutral rate? And I think that it has gone up quite a bit from where it was before. We've seen a lot of different changes globally. We've seen aging of populations, particularly in China, and so less savings when people are older. And so when you're a University of Chicago economist, you kind of think in supply and demand, and if there's less supply of savings, that means all other things being equal, that interest rates are going to go up. So I think the long-run interest rate is a little bit tighter, a little bit higher, and so that's why I think they're probably not going to push rates down quite as much ultimately as many market participants think.
You said a little bit higher. Bill Dudley said a lot higher. I'll share the quote from him. I'm sure you've seen the piece. Bill Dudley put this out on Bloomberg Opinion yesterday. The Fed is wrong about how low rates will go. This time around, the market has it right. The federal funds rate will probably stay a lot higher than what officials are projecting. Randy, can you give us a little bit more color on that? What kind of numbers you'd be projecting?
So I think that's right. I think that the Fed is now thinking things are going to go a little bit more back to where they were just over the last few years, but I think they're more likely to go back to where they were kind of pre-global financial crisis, and so that would mean that the long rate is in the longer run, the rate is going to be closer in the sort of 3.5%. Used to be around 4%, rather than the around 3% that they're thinking now.
Randy, earlier last month, you talked about the idea that potentially you're not in the business of predicting markets, but stocks seem fairly priced to perfection from your point of view. They're even more priced to perfection, some people could argue now, given the fact that we've made new all-time highs several times since then. How much is this the Fed's issue? That frankly, the Fed has fueled the rally that you think has caused price to perfection, given the fact that they basically have not batted away any of the financial conditions concerns and basically have said that the balance of risks for them seems to be to cut rates in the near future.
And so certainly we're seeing a lot of economic strength, I think more than the Fed had predicted, more than most economists had predicted. But you're starting to hear from them that they're going to hang tough for a while rather than start cutting rates quite as quickly as the markets had expected. And you've seen a pretty big shift towards where the Fed is. We've been on this program many times where it said, I think the markets are much too optimistic about all those rate cuts. And now the market is much closer and maybe even a little bit tighter than where the Fed is. That strikes me as reasonable. So I think at least for the piece that they have some impact on, the market expectations have moved closer to them.
Randy, this was great. It's always great to catch up with you, sir, on the first Friday of the month, on Payrolls Friday. The former Fed Governor, Randy Krosno, the jobs report about 5 minutes away. Mike McKee with us around the table, ready to break that one down for you. Mike, what's the big focus for you this morning?
Well, it's been the headline number because basically Jay Powell has told us that's what they're looking at, the strength of the labor market. If it starts to get weaker, then they would consider cutting sooner. That could be reflected in the unemployment rate, but we're seeing all these people come into the labor force, as you were just talking about, which affects the unemployment rate more than it affects the headline numbers.
Should we play a game? Would you rather be here or in Lake Como with Mohammed Al-Arian? Where'd you rather be?
If I were to be honest, I'd go to Lake Como because I could get on the internet and watch the Bloomberg numbers.
This is basically me lobbying to take us to the Amperseti Forum
Is this
next
what it
year.
is?
Oh, sign me up. Yeah.
I mean, seriously.
Yeah, Mohammed is trying to basically say it's so rough for him because he's there with all of the cameras.
Oh, yes, super rough.
We feel just terrible for you.
Sounds absolutely shocking. Coming up very shortly, Mohammed Al-Arian in Lake Como to break down the jobs report, and Jeff Rosenberg slumming it over at BlackRock HQ. Catch up with them in just a moment from New York City. This is Bloomberg.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Ratio.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
The unemployment rate does tick down to 3.8% as forecast. A lot of people watching the manufacturing payrolls number comes in flat. It was down 4,000 last month, so that's not as good as expected, but it's not as bad. And remember, we had that good ISM manufacturing number. Average hourly earnings come in as forecast, up 0.3 for the month and up 4.1% for the year. Now, it was 4.3% last month, and even though the monthly number was higher, base effects come into play there. Average weekly hours, 34.4. That's up 1, which suggests some additional strength in the economy. And the labor force participation rate is up to 62.7 from 62.5. The quick look at these headline numbers suggests that the economy is strong, the labor market is strong, and we're still seeing people coming into the labor force. I'll get some more detail for you.
Mike McKee, the equity market dazed and confused. And as we often say, in the immediate aftermath of a jobs report, the first move isn't always the right one, and we'll see if this one sticks, but here we are. Equity futures on the S&P 500 just about positive by 0.1%. In the bond market, yields, of course, higher on a 10-year by 6 basis points, getting back to about 437. The high of the year earlier this week was 442.74. We've been all over the place this week, but off the back of the jobs report, yields up, dollar stronger. Switch up the board and get to the euro. The euro breaking down to about 108, just about holding on to that level. 108.10, we're negative by about 0.25%. Going through the numbers here, Lisa. 303K against an estimate of 214. Wage growth, even though jobs beat, comes in line with expectations. So the question you've got to ask as you work through this data, does it change the overall theory, the thesis at the Federal Reserve right now, that they don't have to worry about strength because it's not coming with big inflationary pushes higher?
That's exactly where my mind went when I saw how little, frankly, the bond market reacted to this. If you believe that this was really a headline-driven number, you'd expect a bigger sell-off in the bond market. You are seeing yields climb, but it's not an onward kind of climbing. If you look at some of the revisions, they were not revised downward so much last month in terms of just the headline numbers. This is a market that is creating an incredibly above-average number of jobs. I will just note this. Yesterday, the revisions for last last month's wage increases were revised up. So when you start to put this together, on the margins, it's a robust labor market that does still have that inflationary pressure underneath.
I'll go through the headlines and Mike can give you the details. So we come in at 303,000, the estimate 214. If you're looking for unemployment, that came down to 3.8%, in line with expectations, down from 3.9. Wage growth month over month, the estimate was 0.3. We got 0.3. Mike, you've had a few minutes to chew over it. What are the details that jump out for you?
Well, the biggest detail that jumps out for me is the household survey employment number. It's been negative the past few months, and people were suggesting that was perhaps a reason why the story of immigrants coming into the labor force wasn't true. We had more people employed in the household survey than we do in the establishment survey. 498,000 added after 3 months in a row of negative prints. Unemployment down by 29,000. So we've got a reversal there, suggests maybe some noise in the earlier numbers. We have the labor force rising by 469,000. So people who are suggesting we are seeing maybe an immigration effect into the labor force could be right, because we do have a lot more people who were searching for jobs last month. In terms of where they got jobs, healthcare, 72,000 as always, and we are looking at government increasing by 71,000. Construction, 39,000. Some people thought we might have shot the entire arsenal last month with construction work, but it looks like they were able to find workers, and that means maybe housing is going up at a faster pace, and some of that infrastructure work is being done. Leisure and hospitality, 49,000, returning now this month to its pre-pandemic February 2020 level.
This is the 39th straight month of growth that we have seen in the United States, and it raises a question of how much and how long this can go on before growth itself can still remain something that is not a problem for a Federal Reserve. When you take a look at wage growth, does that offset the potential positive inflationary shock of these numbers? Is this enough to give the Fed a little bit of an easy feeling that even though we're getting such positive numbers, it isn't necessarily inflationary?
Well, it tells us that the narrative is not turning wrong, turning the other direction, that we are still seeing wage rates come down. They are above where the Fed would like them to be. They think 3 to 3.5% is what's sustainable. We don't see inflationary pressure necessarily then in the wage numbers yet. Now the question is, the other things that are happening out there, like gasoline prices going up, are they going to push people to go back to the boss and say, hey, inflation, we need more money? Most people don't get raises in the middle of the year, and we've had the big contracts already at the unions, so this may keep the Fed on track to cut rates, but I don't think the strength of the numbers makes an argument to do that anytime soon.
Does this report mean that the Fed actually needs to be more focused on inflation? It can give itself more time for inflation to come down because the jobs market is not deteriorating.
Well, that's the argument they've been making, that they have time, they don't have to jump into this because the economy is strong and the labor market is the reflection of that. Companies wouldn't be hiring if they thought we were going into recession. So if we're not going into recession, then the Fed doesn't need to cut rates right now.
Later and fewer is different to hiking again. And at the moment, Bramo, you look at data like this and you start to think about later, maybe later in the summer, perhaps even September, and fewer, maybe not 3, perhaps 2. But we're certainly not having a conversation about hiking interest rates because wage growth is running away off the back of that jobs growth.
Which is the one thing that people say is keeping some sort of floor under this market. What we do see in some swaps trading right now is the idea of a full rate cut being priced in now in September rather than July. So later and fewer seems to be where the market is headed.
But later, next Tuesday, CPI gets even more important now because the Fed is going to be looking to see if inflation is coming down or if we're starting to see a rebound because of this strong economy.
If things could change quickly, we've been whipsawed 5 different ways already this week across 5 different days. If you are just joining us, the payrolls report comes in at 303,000. It's a big upside surprise. Again, 214 was the estimate. If you work your way through the report, the unemployment rate comes down to 3.8%, down from 3.9. Average hourly earnings month over month, 0.3, in line with the estimate of 0.3. The equity price action looks like this. We're positive 1/3% on the S&P. We're up by 0.4% on the NASDAQ. The bond market price action, if you switch at the board, looks a little something like this. Yields up by 7 basis points on a 10-year, getting closer to 440 again after breaking through that level earlier on this week. The 2-year yield higher by 4 or 5 basis points, getting very close to 470. And I'll give you a snapshot of foreign exchange off the back of this. I'll make it simple. Dollar stronger against absolutely everything in G10. Euro dollar at the moment, 108.15. To break down and react to some of this, I'm pleased to say that joining us from BlackRock is Jeff Rosenberg, and joining us alongside him is Mohammed Al-Arian. Mohammed, you've had a bit of time to chew over this one. What's your big takeaway?
John, it is a jobs report that confirms U.S. economic exceptionalism. You're having a strong supply side, strong demand side. So if you look at the economy continues to benefit from the favorable supply shock. If you look at the Fed, that's not going to change much what the Fed is thinking. And believe me, the administration will be celebrating this report. So overall, a very strong report that just confirms that the U.S. is an economic exception among the advanced economies.
Jeff Rosenberg, do you believe this labour market report is a report this Federal Reserve can fully embrace?
Well, it can fully embrace it, but you know, it is a little bit challenging around the timing issue. I think the key thing in this report we haven't talked about is labor force participation and its impact offsetting some of the wage concerns. And I think that's kind of the good news. Lisa, you asked why a little bit of a more modest reaction out of the bond market for such a headline beat. And I think that's it, is that you're seeing kind of well, it's a strong labor market, but the wage picture isn't, at least in terms of what you see in the print today, ticking up beyond expectations, so that relieves a bit of fears. And then you look at that labor force participation rate ticking up. That's good news for the wage front.
Given all of that, though, Mohammed, why cut? I mean, I go back to what Neil Kashkari was saying, given the fact that the U.S. labor market seems to be doing just great. What is the onus on the Federal Reserve to ease policy that doesn't seem like it's hampering this economy?
It's because policy acts with a lag. These favorable supply shocks are not going to last forever, and there are signs of weakness elsewhere. So you've got to navigate this. You know, you've heard me say this over and over again. The mistake the Fed will make, if it makes a mistake, is being overly data dependent, becoming a play-by-play commentator, and not looking through various things. So you've got to look forward. Yes, we're having a wonderful supply shock. Has a lot to do with immigration, and that's why, as Jeff rightly says, the wage numbers are restrained. They're still not low enough, but they're restrained. But if you go forward 6, 12 months, you've got to be conscious that a lot of what has powered the U.S. so far, including excess savings, is going away.
Jeff, what's your take on that? The argument that Neil Kashkari made yesterday of the Minneapolis Fed, why cut rates if you have robust economic data and a labor market that seems to be chugging along, especially if you do have commodities inflation that people can afford to keep paying because they are still employed?
Yeah, I think it's about really the debate between what I call, and the market calls, maintenance cuts to maintain the degree of restrictiveness, what Mohammed was talking about, that you don't want the lag in policy to eventually become too restrictive by holding real interest rates at these high, at least relative to historical levels, and the threat that that may down the road lead to more tightening than what you would otherwise want. But that's different than saying we need to calibrate the cuts to a slowdown. And I think what Neil Kashkari is talking about is really pricing out really what already happened in the bond market. We came into the year pricing in 7 cuts. We're now 3, maybe pushing down somewhere between 2 and 3. I still think that's right in the sense of you want to have that insurance. And this is a Fed that is very much wedded to trying to secure the gains of the soft landing.
Jeff, how dependable do you think this economic data is? That's a subject we've revisited a few times over the last few months. How dependable do you think it is?
Well, you know, it's really interesting, the backdrop to what's going on in the movement to reprice away from 7 cuts to 3 cuts is that you had this debate between 2 big sources of data, both for growth and for the labor market. On the growth side, it was the debate between GDP and GDI. GDI had been lagging the strength that was shown up in GDP. That gave a lot of people in the market a lot of evidence that, hey, this economy is a lot weaker than we thought. What did we learn most recently? GDI rose to GDP and validated the stronger story. Similarly, on the labor market, you had the gap between the household and the establishment survey. And a lot of people saying, oh, the establishment survey, the headlines is overstated. Look at the household weakness. Well, now what we're seeing, and that's the latest theme, is no, it's the immigration that's not being captured. The labor market is much stronger. So in both cases, with respect to kind of alternative data, you had a debate. That debate is pushing more on the side of, no, this is actually a stronger economy than we thought. And that's what's validating this kind of move to push back from 7 cuts to 3 or less cuts.
It's the supply side story I think we all struggle with, Mohammed. When you really start to think about it, what the Federal Reserve is telling you is that basically don't worry about strong data like payrolls growth of 303,000 because it's not coming along with stronger wage growth off the back of that because we're embracing this big supply side phenomenon. At the same time, Mohammed, they're also pointing to the labor market as evidence they are sufficiently restrictive. And I struggle to reconcile the two things. Can you reconcile the two things? How can you use something as evidence of being sufficiently restrictive but also acknowledge the majority of it is supply driven?
Because they're trying to have maximum optionality, John. And that's what they want. It's the same thing that led Chair Powell at Stanford to say, on the one hand, the inflation story has not changed after the hotter than expected prints in January, February, but on the other hand, we need more evidence that actually the inflation story is what we think the inflation story is. Look, I would be doing the same thing. They are trying to maintain optionality, and they are having competing claims. Also, don't forget that the positive domestic supply side story is countered by a very negative international supply side story. So they've also got to balance these two things out.
Mohammed, I was struck by what you said a while back, where you were saying that this is going to be a Federal Reserve that ultimately will probably accept a 2-point-something inflation rate. If you take a look at the preliminary bond market action after this report, and understanding that the first reaction isn't always the right one, this bigger sell-off is in the long end. This is basically a confirmation that this market believes that the Fed will make good on its promise, essentially, that it will cut rates at some point this year, while allowing inflation and growth to continue to run at a somewhat hotter speed. At what point does that become concerning to you, Mohammed?
It only becomes concerning, Lisa, if it de-anchors inflation expectations. I think there is a slow but sure migration in markets, even among policy observers, and certainly among quite a few economists, to the view that, yes, we're not going to get to 2%, we're going to get to above 2, closer to 3, and that's going to be stable. And the policy mistake would be to go after 2% inflation too quickly. You heard Bill Dudley yesterday, and I agree with him, saying, you know, think more about a 2.5% inflation rate on average. You've heard about how asymmetrical the Fed is to when it misses on one side or the other side on inflation. Look, we're going to settle into an inflation world that's higher than 2%, and I suspect that that is stable. The risk is to try to force it down when the economy can sustain a slightly higher one, because you then undermine economic well-being.
Which raises this question, Jeff, about at what point the bond market will adequately price in a higher inflation future. John was talking about the BMO survey and how there essentially is an inherent bias among bond investors to buy duration, to buy longer-term bonds on sell-offs, just simply because they believe the Fed will achieve their goal and will continue to set rates at a lower rate. How much can you get behind that, and how much do you push back and say, no, there is something else afoot in the long end of the Treasury curve that makes you not like them?
Yeah, I really think that with rates at this level that we're going to shift away from that view that the long end is the best place for the hedge. You know, it used to be a long time ago that flight to quality meant that the curve would steepen, that the best performance in terms of yield change would be in the short end. And I think that's the environment that we're in. If you go back a year ago during SVB, that was exactly what you saw happen in the curve. The best performance in terms of yield change for your hedges, you know, granted that you need to have the right notional amount to make this a fair comparison, happened in the front end. The strongest negative stock-bond correlation by bond maturity was in the 2-year. The weakest was in the 30-year. And I think that's the environment that we're in. And as we start to see more evidence of that, that's going to help, if you will, to bring back in some term premium. Because part of the flattening of the term premium was the pinning of zero interest rates in the front end, which meant that a flight to quality had to be in the back end because you didn't have the room to run in the front end. With the level of front end inversion that we have today, you go back to that earlier kind of textbook that flight to quality is in the front end and a steepener. And that I think is going to help to bring back a higher level of term premium, more consistent with the inflation narrative we just heard from Mohammed.
Interesting. Jeff, before you go, I want to talk about stocks with you as well. Just to put a bow on it, is this a stock market-friendly jobs report this morning?
You know, I think it's okay. I think when you look at the stock market, what we've seen this year is a lot less dependence on the denominator, right? It's last year was all about inflation expectations, the 5-year driving headline equities. You've seen a lot less of that, so I think it's less of an issue because so much more of what we've seen in stock market domination is really coming out of the numerator. It's coming out of the earnings, the power of secular growers, really overwhelming the much smaller concerns in terms of the degree of change that we're seeing in terms of the denominator.
Jeff, this was great. I know you've got to run because you're at work today. We're not all in Lake Como. Jeff Rosenberg of BlackRock has got to run. Mohammed's going to stick with us, I'm pleased to say. If you are just joining us, we've got the brilliant Mohammed Al-Erin of Queen's College, Cambridge alongside us to break down this jobs report. Jobs report about 20 minutes old now. These are the numbers for you. 303,000 against an estimate of 214. 3.8% was the unemployment rate. The number we were looking for was 3.8. That was down from 3.9. Wage growth, 0.3%, in line with the estimate of 0.3%. So here's the reaction to it. Equity's just about positive, still. A third of 1% higher on the S&P and on the NASDAQ as well. In the bond market, yields do bleed higher by 7 basis points or so to about 438 on a 10-year. On a 2-year maturity, yields are higher by 6 basis points and back through 470. When you get higher yields, typically you think about a stronger dollar. It's what you've got against everything in G10 today. The euro is weaker. The dollar is stronger against the yen, the euro, sterling, the Aussie, you name it. Basically right now the dollar's stronger against it. We're breaking down to about 108 on euro dollar. Mike McKee with us around the table to break down some of this jobs report. Mike McKee, you've had about 20 minutes to pore over this one. Anything else jumping out to you about what's behind some of this?
Well, obviously the big rise in the labor force is what's going to intrigue a lot of people because of this debate over whether undocumented workers and immigrants in general are propping up the labor force and helping it grow. We don't have exact numbers on, they break down by foreign-born and native-born, but the foreign-born slipped a little, the native-born rose a little bit, but it doesn't really tell us the answer to that question. Other interesting thing is the government employment continues to rise significantly, up 72,000. In this case, the biggest part of it was in local government, excluding education. We'd been seeing big gains in education, but now it's local government, not education. It's not the federal government, so you can leave that part out of the politics. Only 9,000 jobs created there. And looks like yeah, none of those were in the Postal Service. Oh, they were in the Postal Service, 9,000 in the Postal Service. Beyond that, it's not a thing.
As I've mentioned a few times, at the Unprecedented Forum, Mohammed Al-Erin of Queen's College, Cambridge, alongside us. Mohammed, let's get into a piece you wrote earlier this week on American exceptionalism for Bloomberg Opinion. You've mentioned that a few times. What you didn't mention was something you pointed to in the piece and really highlighted, and it was the difference between what's happening in Germany versus what's happening in the US bond market. Mohammed, how important is that spread between the two at the moment?
It's important, and it's the reason why you're seeing the dollar strengthen. Look, John, it's gone up to about 200 basis points. If you look at the last 3 years, the low was 97 basis points, and it reflects two things. One is that U.S. economic growth has and will continue to outpace Germany's and the rest of Europe. And the second thing is that inflation will come down in Europe faster than it will in the U.S., and you may well end up with more ECB hike as much as the Fed. And I think the markets are starting to incorporate these two things, and that single differential captures really well these different factors.
Yeah, I'm struck by the idea that the U.S. immigration story is so different from other areas around the world that are facing real demographic problems like the Euro region. From that point of view, when does the euro become a problem in terms of a weakness and an importing inflation issue, or is that almost a welcome development so that the European region can compete against American exceptionalism?
It would be at the margin welcomed. I think more concerning is what's been happening to oil prices, and that's something we don't talk enough about. But when you see Brent in the 90s, that is going to have a stagflationary impact on Europe. You know, it's good to come and visit and participate in these European conferences, and the one here at Ambrosotti is excellent because you hear a completely different narrative about the economy, about what's happening to the supply side, and you realize how exceptional the US is right now. And this divergence is not just going to stay, it's going to increase over time. And that's something important when people want to rush to fade the US in terms of equity allocations elsewhere. Just look at the underlying stories. They are very, very different, Lisa.
Well, just to put together some of the things that you said, given the fact that we are seeing oil prices rally, are you saying that that could be a stagflationary shock for the European region, and that, frankly, it could only widen the divide between Europe and the U.S. that also stands to benefit on the other side from higher oil prices?
Yes. I mean, I wouldn't say shock as much as I would say stagflationary headwind. And it makes a transition that Europe needs to make, which is the US is making, from an old exhaustive growth model that depended on exports to China, that depended on all sorts of things that are no longer happening, to a new growth model that stresses things like generative AI, life sciences, sustainable energy. It makes that transition for Europe even harder. So yes, it is an important factor to keep in mind because Europe doesn't need additional headwinds right now.
Mohammed, we'd love a final thought on what we got this morning and what it means for Fed policy. This from Torsten Slock of Apollo. He said, the source of this strength is easy financial conditions. We are sticking to our view that the Fed will not cut interest rates this year. Mohammed, what's your reaction to that? And do you agree?
So I understand where he's coming from. He even had a non-voting member of the FOMC yesterday roll market by a statement. I think that if this Fed is continuously overly data dependent, then maybe we don't get cuts. But I'm hoping that they will see through the backward-looking data and look forward. And I think we will end up with 2 cuts this year. It may not start as early as a lot of people thought initially, but I do think we will get 2 cuts.
Mohammed, this was great. Thanks for making time for us today. We appreciate it, as you often do on Payrolls Friday. Mohammed El-Erin of Queen's College, Cambridge, working through another upside surprise, Lisa, on the jobs report.
You mentioned Torsten Slock, the headline of his piece, the economy is reaccelerating. And that, I think, is going to be one discussion point for a lot of people. How much acceleration is going to be a problem for the Fed, or is it just simply welcome for one that really is prioritizing inflation coming down, even a little bit being the most important aspect?
I like to go up to Mike's point earlier where he said this is going to be welcome in the White House. But you have to think, in December, Biden said we were in a sweet spot. The Fed shouldn't be hiking rates. Potentially they're going to cut. Is good news actually bad news for them? Because it means going to an election year, they might not get a rate cut.
You know what I haven't said once all morning? Let's get you to the weekend.
Thank
you.
Let's get
you to the weekend. There you go. 35 minutes away from the opening bell. Equity futures positive by 0.4%. It's another rock-solid jobs report, a big upside surprise. The source of this strength, we could debate it all day. It's not coming with runaway inflation. What does that mean for this market? Stocks are higher. The bond market's hanging in there. Yields approaching the highs of the year, close to 440 again on a US 10-year. To debate it on Monday morning, Jeff Yu of BNY Mellon, Lara Rain of FS Investments, Jimmy Chang of the Rockefeller Global Family Office, and the brilliant Subhadra Japa of SocGen. To all of you out there, have a wonderful weekend. We'll see you Monday from New York City. This was Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases, or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From New York City for our viewers worldwide, a very good morning. I'm Manus Craney in for Jonathan Ferro. It was a banger of a jobs number, 303,000. Up went the yields in the market, but the equity market for now embraces the good news story on payrolls Friday. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
It is another hot U.S. payrolls report. Treasury yields and the dollar spike on the data, and investors continue to adjust the rate-cutting bets. We begin with the big issue. It is Jobs Day in the USA, and another upside surprise. Bloomberg's Mike McKee is side by side with me. 303,000. Start of the day is...
I'd say that's it. I mean, that's the biggest rise we've seen in about a year, and it also suggests that we are seeing ongoing strength in the overall economy that will keep the Fed sidelined for longer, which is the way the markets are taking it. Payrolls 303,000, net revisions 22,000, breaking a string of several months of revisions down. Unemployment falls to 3.8%. Average hourly earnings come in just about as expected, 0.3 and 4.1% on a year-over-year basis. That is the trend that they want to see at the Fed. So it doesn't suggest that this strength in the economy means they need to consider raising rates or anything like that. The interesting thing that we have been seeing is this debate about whether or not we are permanently in a higher hiring pattern. When you look at non-farm payrolls, they've been over 200,000 for quite some time, and the Fed has said we need about 100,000 to sort of be neutral, to not have employment that is pushing inflation higher. So we're well above that, and we're not pushing inflation higher at the moment. So that suggests that we could see this kind of strength go on, which would have implications for monetary policy. Where were the jobs? Pretty much in the same places we usually see them. Healthcare up 72,000, government up 71,000. Construction was interesting. There was a thought because it was strong last month, it wouldn't be as strong this month, but look at the numbers, 39,000. And of course, as always, leisure and hospitality continues to add. This is the first month, Manus, that leisure and hospitality got back to the level of employment it had before the pandemic. And finally, the establishment versus household. There's been a debate about whether undocumented workers are taking over, are really filling in some of this labor force. And what people cited was the decline in the household survey for a couple of months. But now all of a sudden we had 489,000 people added to the household survey jobs number, which was even higher than the establishment survey payroll. So I'm not sure where that leaves that theory, but we can tell you that all of this leaves the markets thinking the Fed might not move till September.
Well, they're certainly pushing that out in the swaps market, aren't they, Mike? The first rate cut now to September from July. It's been incrementally moving out through the week. The sage of Wall Street and BlackRock, it is Rick Reader. Rick, good to see you. Jobs day, here we are. It's justifiable to be cautious, prudent, patient. The Fed are right to give us that tone, given the backdrop of this jobs report. Agree or disagree?
So I agree, but listen, I think when you step back, there's something really impressive going on here, and Mike talked about it. We're bringing more and more people into the workforce, some through immigration. I'm a big believer in effective immigration, but you're actually putting more and more people to work because you're expanding the workforce. I've talked about it actually because of work from home. You're actually increasing the size of the female population in the workforce. Think about what this means if you're the Fed. You actually brought a lot of people in the workforce. You're hiring a lot of people, leisure, hospitality, healthcare, education, government, not as interest rate sensitive, those areas, leisure and hospitality maybe a bit. But what you're doing is you're growing the potential of the economy. And if you look at average hourly earnings, they actually didn't go up. So what's happening is you're expanding the workforce, putting a lot of people to work. And actually, you're not pressuring wages of any significant magnitude because you're expanding the workforce. Supply side story, pretty darn impressive. Can the Fed be more patient? Maybe, but you think about what's happening. We see this in all the data. Lower income people are getting hurt by some of this. Some of the demand function, the cyclical parts of the economy are under pressure. Could the Fed still get the rate down from 5 3/8 since we're getting, core PCE inflation we think will be running at 2.5%? I still think they're going to move. I still think they want to move. Could they be a bit more patient? For sure. But listen, I think when you step back, the story's a pretty good one for the U.S. economy.
No, it's a very bullish story. Stocks are doing well. Yields are popping a little bit higher. You say it's a supply side, and that is demonstrable in the numbers. So the non-aggressive spike in wages, that is presumably adding into a lower ECI. That builds to the narrative that you said we will get insurance cuts. We've got Torsten Slot coming on the blog right now saying he sticks with 0 cuts. You call insurance cuts. What are your insurance cuts to 0 at Apollo?
So I would say a couple things from my perspective. I think the Fed would still like to get 2 to 3 cuts in this year. You need to see the data improve. You need to see the inflation data. I think our data suggests you're going to get core PCE numbers over the next couple of months of 0.2 type of readings month on month. That'll get your core PCE down to a run rate of about 2.5 over the next couple of months. 2.5 core PCE, 5 3/8 funds rate. I'm not saying the Fed needs to get away from a restrictive policy given the strength of the economy, but even if you got 100 basis points off the funds rate, you're still operating at a restrictive level. So I still think they'd like to do it. We need the data to support it. We think we'll get that, but listen, we got to see it first for sure.
Look, obviously, and that's why we're getting all of this rhetoric about more confidence and take more time. And then Kashkari flies the kite of 0 hikes. Can you just don't see that as a possibility? You think we will get them. So therefore, on these spikes in yield, this goes back to, we had the same conversation a month ago, didn't we? Which was, do you want to step in and buy the spike in duration? Just a clean-cut answer on that before we move on.
So I love buying the front to the belly of the yield curve in income-producing assets, credit, securitized market. You can clip a coupon of 6.5%. My new ETF Bink is trading 6.80 yield. Even if rates go up 20, 25 basis points, you think about what happens. You still carry it over 50 basis points. You still create income over 50 basis points a month. You carry right through it. That I'm definitely comfortable buying. Pricing in the Fed anything more than a couple of cuts, I wouldn't do that today. And so no, we're not adding any significant duration. In fact, we've cut some. But I love owning this income because your income works for you even if rates move moderately higher.
And this is where the real money potentially comes in, doesn't it? Can we get a quick view on oil? Oil's over $90. You know, if we look at yesterday had three different things happening, didn't it, Rick? It had oil spiking on $90, geopolitics, Netanyahu's next step against Iran, Iran against Israel. We also had data to contend with as well, and Kashkari flying the kite of zero. To what extent is the left tail risk of stagflation now materially more present, perhaps, than it was a month ago when we last caught up?
No, I don't believe in stagflation. I mean, I think the reason why energy prices are moving higher or oil prices moving higher, you've got an economy, obviously, at the Mideast situation, which caused that spike over the last 24 hours.
Yeah.
But the economy's operating at a pretty good level. Consumption's operating at a pretty good level. And actually, the high-frequency data out of China is a bit better. And so you're starting to see that. You're seeing that in some of the data globally. So I think you've got what is a pretty decent consumption story that's buoying some of those levels. And then obviously the exogenous from the Mideast is creating some of the recent move.
And in terms of the price action, as you say, over the past 24 hours, to a certain extent, I put it to you that was the bond market showing its reaction function as a hedge.
So yeah, 100%. You know, it took a little while, but it did show the bond market. Listen, I mean, it'll be interesting to watch at the end of the day in terms of how we go into the weekend, because when you've got news swirling, long end interest rates don't do a lot today, given the nature of the curve. I've talked about, you know, owning the belly of the curve, owning a lot of income. Like, why do you need long end interest rates with a curve this flat and with the Treasury after issuing a tremendous amount? There's only one time you really need it, is if you believe you have some exogenous. So having some long-term interest rate at times will make some sense, and you could see that, like you say, you know, when you get shocked events, it does tend to be a useful tool. The thing that I think is extraordinary today is the volatility of the equity market, where it's priced. The VIX, you know, we do a lot of trading in the options market. Volatility is crazy cheap in equities. I'd much rather use that to manage my risk than count on long-term interest rates to be, you know, with the data we're seeing, to be my ballast in the portfolio.
So tell me, would you be a buyer of VIX? Would you actually be prepared to spend money on buying protection? Because various people have come on board here and they've said, actually, we quite like riding volatility at this stage and clipping the income there, clipping the basis points there.
Be completely clear. I love buying volatility in the equity market. And, you know, there's some parts of it you can sell, some single name, like some of the names, some of the companies that have run up quite a bit in tech. Can you write some volatility, some call options against it? Can you overwrite some of the positions? For sure. But gosh, we've been able to continue to buy call options with volatility under 10 on the index, on the S&P 500. If you believe, which I do, that equities will go higher, you don't have to run a big risk position just by using call options and using volatility in the market. Rate volatility has been, I mean, think about, you know, we're talking about rates moving around. The 10-year note hasn't really moved a lot. Rate volatility is actually high. Equity volatility, I think, is amazingly cheap, particularly if you trade the underlying collateral, the delta. You know, if you think about what happened the last 2 days, you had the S&P 500 moved, what is it, we moved 100 handles yesterday, so 3%-ish, a little less than 3%. Like, I don't know. That's a pretty good. If you're not paying for the volatility and you can move your position around relative to it, I think equity volatility is really, really attractive.
That'll be the line in 2024. I love spending money on volatility. That's definitely, we're supposed to be talking about bonds, and you and I have ended up talking about buying equity volatility. We're both going to get into trouble. Just to sort of close it off, the debate we had Bill Dudley yesterday, of course, talking about where we will end up, and saying that essentially the Fed is wrong. The Fed's down there at, what, 275, and the market is at, 3.25, give or take, depending on where we are in the day. So where do you see that terminal rate?
So, by the way, I actually don't think we're talking in different arenas around the around the dynamic that we talked about. If you can build a lot of income in a portfolio, this is nirvana in fixed income. If you can clip a 6.5%, you have some money to play with to buy some volatility, cheap volatility in the equity market. So I actually think they work hand in glove pretty well with one another. Listen, I think you have to assume the terminal rate, and certainly when you hear Fed governors, Fed presidents talk about it, the discussion is a higher terminal rate. What I argue, we're going to see a lot around AI over the next couple of years. We're going to see a lot about how. So listen, I think you have to assume the terminal rate's a bit higher. Is it 3-ish? Is it around that zone? I think we're going to learn a lot in the next couple of years. And I've said, put money to work. Think about your investing with a 12-month time frame, because between AI, how U.S.-China develops, how elections go, we're going to get a lot more information to determine where we're going to be 2 years hence. And I'd rather make the decisions for what's going to happen in the next 12 months, 6 months to 12 months.
Yeah, I think we will have a much clearer, we'll have a U.S. election under our belt with some clarity in terms of who might be in the White House. And that, Rick, of course, has got big implications on the fiscal trajectory for the U.S. Rick, good to have you with me. Rick Reader there on the reaction to the jobs report. If you're just tuning in at 9:12, where have you been? 303,000 jobs were created and a participation rate that goes up. The opening bell is just over 18 minutes away. Abigail Doolittle is with me.
Despite yields being higher, Manus, on that hot jobs report, we do have tech stocks in particular staying higher, including Netflix up 1.2%. This, of course, also as Pivotal has moved its price target to a street high of $765, suggesting 20% upside. Shockwave Medical up 1.7%. J&J is buying the medical device company for $13 billion. And then Tesla not joining in on the tech party. This on news that they are offering steep discounts on SUVs, piling up on big inventory, Manus.
Abby, thank you very much. Coming up, Payrolls Friday, we get the reaction from the White House. Anne-Marie Hordown sitting into the seat. She'll catch up with the acting Labour Secretary, Julie Su, in just a moment. That conversation not to be missed on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
On Bloomberg TV and radio, I'm Manus Cranny in for Jonathan Farrow. Let's get to Anne-Marie Hordown. She joins us now with a very special guest from Washington, D.C.
Thank you so much, Manus. We had that blowout jobs report, and we're pleased to be now joined by acting U.S. Labor Secretary Julie Su. Julie, thank you so much for joining us, coming in on this very hot upside surprise when it comes to the non-farm payrolls number. Well, what's interesting, though, is the labor force participation rate increased more than expected to 62.7%. Where do you see this supply coming from?
Good question. So yes, this was another incredible jobs report, right? 303,000 jobs created, bringing the total since President Biden came into office to 15.2 million. Unemployment rate remains at historic lows. And yes, the labor force participation rate overall increased, and that number actually comes a lot from young workers, from teenagers. The overall, just in the prime age workforce, remained steadier. So that's where that supply is coming from.
There's a lot of talk, though, this is also coming in from higher immigration, both documented and undocumented. Are you seeing that as well?
So our numbers demonstrate that that particular data point is coming from young workers, but certainly, you know, a positive economy, a strong jobs, situation is good for all workers, immigrants included. So we are certainly also seeing, you know, immigrant workers and native-born workers really be part of this this overall story of growth that's much higher than expected, not just this month, but over the last several months.
Jay Powell talked about this earlier this week. He didn't want to get political when he talked about immigration policy, but he said he wants to call the strikes and the balls of how he sees it, which is more immigration, creating a bigger economy with more capacity instead of a tighter economy. Is that what you see, a growing economy, maybe because of this influx of immigration?
Well, so we continue to see this tight labor market, in part because we're seeing growth in jobs and labor force participation rate high, right? But to your point, you know, immigrants have long contributed to a strong economy. And so this overall high GDP, yes, is a function both of, again, immigration and immigrant participation in the workforce and overall participation. You know, these unemployment rates being at historic lows are true pretty much across the board.
One area where we didn't see any improvement was manufacturing employment after a drop last month. We spoke about this last month, where there's a loss of 10,000 jobs in February. The president likes to talk about boosts in manufacturing space. Why are we not seeing more of that?
Yeah, that's right. So we've seen about, you know, over 700,000 jobs in manufacturing created since the president came into office. This last month, we saw one of the industries of large growth was in construction, especially specialty construction. So these are carpenters, these are electricians. And so there's building going on. And you gotta, you know, build the factories before you have people working in them. And so we've seen steady growth, but the manufacturing kind of follows the construction, and this is a moment of historic investments as part of the president's Investing in America agenda in both of those industries, and 2024 will continue to be a big year in manufacturing.
But Julie, when you look at the blue wall, Wisconsin, Pennsylvania, Michigan, these three key industrial swing states, a collective 39,000 fewer people are working in manufacturing than 5 years ago. Where are those manufacturing jobs going? And how uneasy does it make you that the blue wall is losing key manufacturing jobs?
So the president's been very clear. We are going to make things in America. We've invented them here. We should be able to make them here. That is part of the truly unprecedented investments in industries, including in manufacturing. I've been to Michigan. I've been to Wisconsin, and we're seeing working people in apprenticeship programs that are bursting at the seams. We're seeing people talk about a sense of security, about a career that they're now going to have that they didn't see possible just a few years ago. So that's the trend. The numbers don't lie. The numbers reflect that also. And again, we're seeing them in construction. You know, really big growth last month, and we will continue to see growth. Again, you know, there's sort of one has to come before the other, and manufacturing is an area of big investments and under President Biden, and I trust that those numbers will be reflected as we go forward.
Right, but less people have been working there since 5 years ago in those three states. Where are they going?
Yeah, so, you know, we're not afraid to tackle hard problems, right? And one of them is to reverse the trend that you're talking about. There was a long time trend before President Biden came in of manufacturing moving overseas. The president said very clearly, not on my watch, not anymore. That's a function of wanting the jobs to be here, wanting them to be good jobs that provide a pathway to the American dream, but also about a resilient supply chain. It's about our national security. And so all of those are part of the vision that he came into office with. And frankly, you know, the growth that we've seen over the last 3 years was not promised. Most people said it could not happen. And across, again, all industries, there has been growth, much of it returning to pre-pandemic levels, right? We're talking about hospitals and healthcare. We're talking about local education. Local education returned to pre-pandemic levels for the first time this past month. And we will continue to see growth in manufacturing, not by accident, but because of the investments in the Investing in America agenda.
The unemployment rate, 3.8%. It's been lower than 4% for more than 2 years now, but that's not for everyone. The report shows unemployment rate for Black Americans increased in March. Why is this moving in the wrong direction for Black Americans?
So we pay very close attention to that. You know, again, if you look at the trends over the last 3 years, the Black-white unemployment gap is at also historically low levels. That's because the president has also been very clear. We are not going to build the economy we want if we leave anyone behind. And so a lot of our work at the Department of Labor has been focused on making sure that there are apprenticeship programs, pathways to good jobs in all communities, including in the Black community. We did see an uptick. That the Black unemployment rate there was primarily for Black women, so we're keeping a very, very close eye on that, and we'll continue to work on closing that gap between Black-white unemployment.
Acting Labor Secretary Julie Su, we thank you for your time this morning. Manis, really a blowout report. That unemployment rate for the president is going to be something certainly key. They love to tout this statistic that for more than 2 years now, it's been under 4%.
Swift avoidance there, of course, in terms of answering where have the jobs gone in that blue wall, which, of course, we did the polling in that recently with the Morning Consult poll. Amory Hordown there with the acting U.S. Labour Secretary, Julie Su. Coming up, your morning calls. And a little bit later, Amory and I will catch up with the Deputy Treasury Secretary, Wally Adeyemo, joining us both to discuss the payrolls report, Yellen's trip to China. That's on Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Embrace your U.S. exceptionalism. The equity market certainly does. Yields might be pipping a little bit higher, but this equity market is trying to find favor with that exceptional story. 303,000 in the jobs report. That's pretty hot. Let me tell you what's hot on Wall Street. This is what the scribes are writing. First up, Pivotal raises Netflix price to $765, highlighting a solid momentum in streaming. Piper Sandler upgrades Krispy Kreme to overweight, expecting his recent partnership with McDonald's to be the game changer. Oh, Krispy Kremes. Finally, Seaport Global upgrades Fox to a buy, seeing a jump in political ad spending going into the election. Coming up, Anne-Marie Hordern and myself sit down with the Deputy Treasury Secretary. It is Wally Adeyemo on Bloomberg.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
The American economy is vibrant. 303,000 jobs were created. Manufacturing might be a little bit of a headwind, but this equity market at the moment is trying to see the unique exceptionalism in the numbers. NASDAQ up by 0.3%. Levi's are ringing the bell. This is great. Apparently baggy jeans are back in fashion. Who would have thought? Bring back the bell bottoms, I say. There is the opening bell. We're open, we're bid. Strong jobs report. Wages are good. Participation rate is higher. What is not to love in this market? Let me tell you what else is going on. The dollar is bid all the way around against every single G10 currency. There you go. The euro is down by 0.3% at the moment. You're having 10-year yields pop a little bit higher by 0.6%. You're almost at this year's high again as we see the risk of perhaps renewed inflation. That is also oil over $90 at home in Europe. But of course, in New York, we're at $87, up 0.4%. There is a tightness in the oil market as geopolitical tension rises, and that is giving you a bid-up oil market. There's one stock to watch at the open. It is Tesla, the EV maker, offering big discounts on the best-selling vehicles as its inventories pile up. Craig Trudell is with us. Craig, this is another roll of the dice at Tesla. More price cuts. Everything the market does not really want.
Yeah, that's right. And we've seen them cutting prices left and right for more than a year now. This is a little bit different where they're actually cutting prices of their vehicles in inventory. And the problem that they have here is they have a lot more of those at the moment. They made almost 50,000 more vehicles than they delivered last quarter. And this is something that has become, something investors have become accustomed to because 7 out of the last 8 quarters they've done that. And so this is, a pretty drastic move on their part because you're able to get your hands on a Model Y for much cheaper than you would if you were to custom order one. The big question will be just how long they stick with this small price hike that they moved to at the beginning of this month. Just based on where deliveries have been, it's hard to believe that will stick for very long.
Craig, thank you very much. Let's turn our attention to manufacturing. We've got Greenbrier reporting revenue that beat the average analyst estimates. Abigail Doolittle has the detail. Abby.
Investors really liking this report, Manus. The stock up 9%, its best day in almost a year. And this company, of course, is a supplier of equipment and services to freight transportation markets. They beat both top and bottom line estimates, 20% better on the bottom. That was $1.03 in adjusted earnings. They updated their guidance to a range that is above what was expected. Now, this stock up more than 70% over the last year. Even so, valuation still attractive, trading at a PE, forward PE of about 13 times. That's at a discount to the group. There is a 6.2% short interest, Manus, so I think on these good results, today's pop up 7.5% right now could be a bit of a short squeeze.
Okay, well, we'll leave it there. Abby, thank you very much. Flip over to tech. Now, Apple have laid off more than 600 employees. It's part of a set of decisions to end the car project and the smartwatch display projects. Ed has the details. This is a residual, Ed, really, isn't it, from a strategy pivot?
I'd call it a size and scope understanding of all the reporting Bloomberg's done over the last years. Apple's up 0.3% is actually down on the week more than a percentage point, on track for 3 straight weeks of declines, matching the poor run of form that it had at the end of 2023. And the headlines have been difficult for them. So these are warn notices that are filed with the California Employment Development Department. So we know where those jobs were cut geographically within California, the specific addresses where we know teams were working on both Project Titan and the display project, which has also been pared back. Mark Gurman makes a really interesting point in his reporting that this is just California. Project Titan, the car project, and other projects that have been impacted that we know about through the warn notices have a footprint outside of California in states like Arizona. So the 600 number is very small in the scheme of Apple's overall employee base, but it's likely not the full picture. It's been a difficult week for Apple. You and I have been talking a lot about the robot that follows you around the house. Why do we need a robot that follows us around the house? And we're up 0.2%, but it's been a rough week.
I can always do a bit of help on the housekeeping. Thank you very much, Ed Ludlow there on the latest from Apple. Well, joining us now for more on the payrolls report is the Deputy Treasury Secretary, Wally Adeyemo. Bloomberg's Anne-Marie Hordern, side by side with me. Good to see you, Deputy Secretary. We've had a great jobs report. Anne-Marie and I have spent time talking about that. The debate is this, and we just had it with Julie Sue, is about immigration and to what extent. It's a hot political issue. But how much more embracing of immigration does this administration and the country need to do? Because it keeps the pressure off the wage spikes, doesn't it?
We should start with the fact that the president, in the beginning of his term, proposed comprehensive immigration reform because he understands the importance of us doing 2 things. One, making sure that we secure our border, but also that we have a sensible immigration policy that, to your point, helps us drive a successful economy. And when you look at the 300,000 jobs that were created in the United States this month, it's on top of historic gains in the labor market we've made over the last few years, where we're seeing wages grow faster than inflation, and we're seeing a robust U.S. economy because of the policies the president's put in place, including he's calling for and continues to call for us to do the right thing when it comes to immigration reform.
But that participation rate has ticked higher. Jay Powell's talking about it's a bigger economy, not a tighter economy because of immigration. Do you see that, whether it's documented or undocumented workers coming into America that are filling some of these jobs?
I think it's important for us to remember that one of the things we've been focused on since the end of the pandemic is dealing with supply constraints. Some of those supply constraints were in the labor market as well. And I think that while you're focused on immigration, we've done a lot to reduce supply constraints for all types of Americans. Look at female participation in the economy. We've seen black female unemployment rates go down as well, but seen more black women enter the labor force than at any point since in modern history. Our goal is to do everything we can to take the people who want to work in this country and make sure they have the ability to do that by giving them the skills they need, working with companies to make sure we get labor in the right place. And the president's committed to doing everything we can to reduce these supply constraints because we know they're key to reducing inflation in the economy.
Well, black Americans, though, unemployment rate ticked higher, 6.4%, at a time when we see the president's poll numbers are softer with black Americans, with Hispanics. How much of a political headwind is this for you?
So it's important to remember that where we started. And when we came into office at the beginning of the Biden administration, black unemployment was above 16%. It's come down to historic lows, and I was in the Obama administration, and it took us years to see unemployment come down during the great financial crisis, and we've seen far faster movement there. There's more work that we need to do, but in addition to seeing unemployment rates reduce, we've seen historic gains in terms of the starts of black small businesses and small businesses run by people of color, which have been historic in our country's history as well. So our goal is to make sure that we do everything we can, not only to create well-paying jobs, but to create opportunities for people to build wealth by creating things like small businesses. And what the president's made clear is that we know the job isn't done. We've got more to do, and we have an agenda that it allows these small businesses to get access to two things they want: capital and customers, which are key.
Let's pivot to Janet Yellen. She's just touched down in China, and to a certain extent it plays to some of the themes that you've just laid out, which is about making American jobs real and good for the economy. What is a tangible success from this trip for Yellen?
Let's start from the standpoint that Secretary Yellen's going to China from a position of strength in the U.S. economy. Our economy is growing faster, it's more competitive than any economy around the world, and the reason for that is because of the policy choices that we've made. And success for the Secretary is to explain to the Chinese that the policy choices they're making today, which are leading to overcapacity, are not only not good for the global economy, it's not good for China's economy. They went and overinvested in property, and now they're dealing with that concern. By overinvesting in these industries, they're going to create concerns for themselves. And probably the most important thing you've seen the Secretary do was her meeting with business leaders, not just from the United States, but from Japan and Europe, because our goal here is to create a level playing field for companies around the world, because what we know is that when there's a level playing field, American companies win. So we want to make sure that the Chinese recognize that it's not, their concern is not just with the United States, it's with the global community, where we all are saying to them clearly that you need to address your overcapacity issues because it is not only hurting us, it's hurting you.
She also hinted at this pending tariff review. What's the status?
So the tariff review is in the hands of our colleagues at the U.S. Trade Representative's Office. I'll leave it to them. But what I will say is that we're talking with our allies and partners around the world about the use of tools when it comes to making sure that we address uncompetitive activity coming from China.
Well, you're not just talking to them. There's active pressure. I mean, senior officials will travel to the Netherlands next week to put more pressure on the Dutch to really hold back on chip.
But I don't think we have to put pressure on them. Look at the Brazilians, look at the Mexicans, look at all these countries.
Okay, well, we can use the word pressure or support. We can use the word pressor or support.
Yeah, but they're doing this on their own, not because of America, but because it matters to them.
You're telling me that the delegation are going to Holland and that it's not under any kind of pressure to deliver, to be in sync with the United States of America.
When you look at the officials in the Netherlands or the officials in Brazil, the Brazilians care deeply about the Brazilian steel market. That's why they're thinking about going after uncompetitive behavior from China. These countries fundamentally care about their workers just as much as we care about our workers, and we want to work together as allies and partners to make clear to China that we want to compete with you on a level playing field, but when you take actions that hurt our workers and hurt our companies that are not competitive, we're going to act in unison to hold you accountable.
You're talking about a multilateral approach when it comes to China. Yet at the same time, the president has announced his opposition for the Nippon Steel deal. The Japanese have come out and said, actually, this means that we would be united against China. Which is it?
Our goal is to work closely with our allies and partners to build a global economy.
But not at the expense of union jobs?
That works for all of us, including building jobs in all of our economies. Fundamentally, we just did a deal with the Japanese, that allows us to work together to build a clean energy supply chain, the critical minerals agreement with Japan. But we do believe that it's important that we invest here at home. in building strong jobs here in the United States, which we've done, and the labor numbers today demonstrate that, we think it's possible to do both things. Invest here at home, but also to build out a global supply chain that benefits not just the United States, but Japan and all of our allies. And that's exactly what the president is doing. And that's why we think that working together with those same allies, be it Japan, be it Europe, to address China's overcapacity is important. That's why the secretary, in meeting with business leaders from the international community, didn't just meet with American business leaders, but met with business leaders from Europe and from Japan as well, because we share the same concerns.
But you see how sometimes there could be mixed messages to some U.S. allies. Back to the Nippon Steel deal, though. Is it dead or what?
I'm not going to comment on a private sector deal. That's not my role. What I can tell you, though, is that we're very invested in building a domestic steel industry that can supply the investments we're making here at home, which include the Bipartisan Infrastructure Act, the Bipartisan Chips and Science Act, and the IRA investments that are happening here. And when you look at the numbers today and you see the growth in employment in the country, that's being driven by the policy choices the president has made. And our goal is to make sure that that doesn't only benefit the American people, but benefits our allies and partners as well as we're building out global supply chains.
We're going into the spring meetings in a couple of weeks. When you look around the world, you're talking about growth here in America. It is exceptional, and it is pretty unique relative to the rest of the world. As you go into these spring meetings...
I think the thing we don't talk enough is that the reason that growth is happening is because of our outstanding companies here in the United States, but because of the policy choices we made in the United States that are different than policy choices made in other countries and the president's agenda. And I think our goal has to be, as the spring meetings happen, that we drive a message to the rest of the world.
The growth, to be fair, is driven in part by stimulus, and it is driven by part the lasting effect of the COVID stimulus on the consumer. So that is a policy-driven, let's say, recovery relative to the rest of the world. What's the biggest concern as you go to these spring meetings? What's your message at these spring meetings with the global leaders? You talked about them 3 times now during this conversation.
I think the key for us is to make sure that we address overcapacity, because that is a global issue that we all face, but that we also take steps to continue to drive growth in the global economy. And that while the United States, we're making investments in the energy transition through the Inflation Reduction Act, we want to make sure that other countries are making similar investments, because we know that we can't solve the climate crisis alone in the United States. And we also know that as we think about the energy in general, we want to be in a position where we're transitioning away from fossil fuels, not only because of the climate impact, but also because of the energy security issues.
Can I just squeeze this in? You're putting a lot of emphasis right now on climate and energy security. If that is the case, if climate is the big goal, then why not let the market do its job and let in Chinese EVs?
Well, if it was market determined, that would be one thing. But the reason that China's EVs are flooding the market is because of state subsidies. And fundamentally, one of the things that we learned from the pandemic, but we also learned in general from geopolitical situations, is you don't want to have one supplier of any one good. You don't want to go from Russia supplying gas to Europe to China being the only supplier of solar panels or EVs to the world.
Would you agree that in terms of the EV infrastructure, that this administration, respectfully, has not achieved its goals?
We're still working at our goals. As you know, the IRA is a 10-year bill that's making huge investments, not only in the supply side, but also in the demand side of our economy, and we're seeing results. In the United States, we've seen $600 billion of announced investment in the economy driven by the president's bills. And when you look at the job numbers today and you look at those job numbers and the investment numbers in the economy, those are being driven by policy choices we made here in the United States. And we're going to continue to make those policy choices to make sure America's economy outperforms the rest of the world.
Deputy Secretary, thank you so much for joining us. That is Deputy Treasury Secretary Wally Adeyemo, joining us both with Anne-Marie Hordan around the desk. Coming up on the show, markets digest those payroll numbers.
Something really impressive going on here. You're actually putting more and more people to work because you're expanding the workforce.
That conversation up next with PGIM's Greg Peters and Mona Mahajan with me from Edward Jones on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we've provided ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
When you step back, there's something really impressive going on here. You're actually putting more and more people to work because you're expanding the workforce. The story's a pretty good one for the U.S. economy.
It is another blowout payrolls report. Let's discuss that and the implication for markets. My guests, Mona Mahajan of Edward Jones and PGIM's Greg Peters. Mahajan, Greg, good to see you. Mahajan, this is what you say. The bull market is built on a full head of steam with the mood brightening into what is looking increasing like a full-blown optimism. Well, we just handed you a 303 number on the jobs report, a participation rate that's rising without runaway wages. This is Nirvana, Mona. Good morning.
Good morning. And yeah, you summarized it well. Look, this is giving whiffs of a bit of Goldilocks here. You know, not only did we get the 303,000 number well above expectations, we are now looking at an unemployment rate, 3.8%, 26 months in a row of sub 4% unemployment in the U.S. We haven't really seen that since the 1960s. And then, of course, all of that may have been worrisome if we saw that wage gain figure actually tick higher, if all these new jobs created were leading to higher wage growth, which would lead to higher services inflation. But what we are seeing, in fact, is a moderation in the wage gains. On a month-on-month basis, we're getting 0.3%, but an annual basis, 4.1% is a tick lower from the 4.3% we saw last month. So the trend is in the right direction. The Fed is certainly watching the wage gain figure closely, as well as it has a direct implication in the services inflation figure. More broadly, I'll just add that it does feel like there's better supply and demand, as the Fed has been noting too, in the labor market here in the U.S. We are seeing an uptick in participation, and we're seeing a downtrend in the number of job openings. So less demand, more supply, which is creating this kind of gradual cooling in the labor market that we wanted to see.
Mona, stay with us because we've got Peter with us. Now, Peter, I know that, to quote you, I've become officially exhausted from the non-stop Fed speak that we've had. So, you know, here we are. We've got a debate now. We've got really, really strong numbers again in this jobs report. Kashkari flies the kite of no interest rate cuts. To what extent is this equity market in the United States of America exempt from rate cuts. Does it really need rate cuts? And does it need rate cuts to run higher?
Well, I don't think it needs rate cuts necessarily, but if you look at real rates, if you look at the scope for moderating rates, it's around being less restrictive, right? It's not about being accommodative, and I think that matters and matters a lot. So you're looking at real rates at 2%. There is scope for rates to move lower. So our call all along has been 50 to 75 basis points. I think that's still very much in play. But if you look at kind of dissect the options market, what you're seeing is this probability of rate hikes, right? And so just roll back the clock. Earlier this year, it was almost a foregone conclusion that you'd get 50 in March, and now we're talking about pushing it off, and even the prospect for rate hikes. But bottom line is, it's about the data, and the data are really strong. That's why I keep saying tune out the Fed rhetoric, because we're just following the data, right? It doesn't matter what they say. It matters what the data comes in, and I think that's the important thing to focus on.
And that data has already pushed one full rate cut from July into September. So again, the market is ahead of the Fed, and that gap is widening. Again, there is this differential between the two. You mentioned the word rate hike there. Do you see any tail risk of a hike, or is that just market conjecture and media spec?
I do. I mean, there's always a risk. I would say in most investors' mind, it was a zero probability, and I think it's closer to a 10%. And so as the data comes in strong, as the labor market continues to chug along, yeah, wages have moderated, but they're still at a very high level. That is the key to kind of the future inflation outlook. There is that prospect. So I don't think it's off the table here. So the economy is strong, and I think investors need to look at why the rate behavior is the way it is, and it's because of stronger growth and inflation that's actually still above trend.
Mona, for you, there is this broadening of risk on the equity side. I look at the energy market, and the energy market is juiced because of heightened geopolitical risk and tight, potentially deficit markets. Your breadth that you're going for in energy, does that endure? Will you add to that? And are you concerned about the events in the past 24 hours that will indeed embolden the energy component of this market?
Yeah, I think broadly our call on market leadership broadening beyond large cap technology here in the U.S. is driven by the fundamentals around earnings growth. We think will broaden this year beyond just, the large cap technology or growth parts of the market. We should see other parts of the market, including energy, financials, industrials, materials, sectors that actually benefit when the economy holds up and even reaccelerates, which we think could be the potential outcome, especially if inflation cools and the Fed starts thinking or signaling rate cuts by year end. That's an environment where the consumer will start picking up as well. So we do think this broadening of market participation will happen, and it's starting to show some signs of life already. We have seen sectors outside of tech have leadership in the first quarter of 2024, and we've also seen areas like mid-cap stocks pick up as well. To your point on the geopolitical tensions, typically those do manifest through the oil and commodity markets, and that's exactly what we saw yesterday and really over the course of the last few weeks, but certainly came to a head yesterday when there was an escalation in geopolitical tension. We saw an escalation in WTI, oil commodity prices. That actually weighed heavily on stock markets and sent bond markets into kind of flight to safety mode. So, we'd say the geopolitical tension is actually something that, we are still hopeful that we get a de-escalation rather than a re-escalation. That's the better outcome for the global economy. But the broadening of participation, we think, can happen either way.
Mona, thank you so much. Mona Mahajan of Edward Jones and Greg Peters of PGIM Fixed Income. My guest this morning, first reactions to the jobs report. Coming up on the sector price action this morning, Abigail Doolittle is with me.
Well, Manus, we do have a gain for the S&P 500 of 0.6%. Despite that hot jobs action, discretionary services and technology, those are the sectors that are higher despite yields up too. On the week, though, we are looking at a down week, down more than 1%. Earlier, the worst week of the year, but now we're actually off of those lows to the worst week since January. Most of the sectors on the week, Manus, they are lower.
Okay. Thank you very much, Abby. Trading Diaries up next in terms of what you should be watching for the rest of the week. Have a good weekend. But the solar eclipse comes on Monday. Get your sunglasses out. Congress returns from recess on Tuesday. Wednesday, it is CPI. So more discussion around the inflation narrative here in the United States of America. Initial jobless claims and OPEC's monthly report hits the tape on Thursday. And that oil market is on fire at the moment, quite literally lit up. Finally, the big bank earnings on Friday. JP Morgan, Wells Fargo, and Citi all post results. That was your countdown to the open for this week on Jobs Day. 303,000 jobs delivered without a serious blow higher on the wages. Bonds are spiking a little bit higher in terms of yields. Equities remain robust. Good morning from New York. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele, Paul Sweeney, we're with you here at Bloomberg Intelligence. What we'd like to do in the next couple hours is make that shift from big macro talk that we do on Bloomberg Surveillance with Tom Keene, and also with the focus on Europe there. What we'd like to do is shift gears here in the next couple hours and really focus on the U.S. markets. We're open for trading, focus on companies, focus on stocks. We lean heavily on Bloomberg Intelligence research analysts, and that's what we'd like to do over the next couple hours. Today, it's a blowout jobs day, so we're going to break that down as well. Grace Lee is going to join us, PM at Columbia Threadneedle, and we're going to have some smart voices on this blowout labor number coming up this morning. But first, let's kick everything off with Mr. John Tucker.
All right, stocks in the green right now. The economy adding 303,000 jobs, surging way past estimates. This shows the resilience of the U.S. economy, also indicates the Fed may not have to cut interest rates anytime soon. In fact, traders shifting their bets from a June rate cut to September now. And Jeffrey Rosenberg at BlackRock says the jobs report has some Goldilocks elements to it.
You're seeing kind of well, it's a strong labor market, but the wage picture isn't, at least in terms of what you see in the print today, ticking up beyond expectations, so that relieves a bit of fears. And then you look at that labor force participation rate ticking up. That's good news for the wage front.
And this is going to place more emphasis on next week's inflation report. We get the CPI that is out on Wednesday. S&P 500, 29 points higher. That's up 0.6%, 51.76 on the index after yesterday's more than 1% decline. Dow Jones Industrial Average up 96 points right now. That's up 0.25%. The Nasdaq 100 up 125 points. That's a rise of 0.7%. Now, in the yield space, the more policy reactive 2-year, that's up 5 basis points. That is at 4.70 right now. The 10-year, 5 basis points higher. That's at 4.35%. And we will brought to you by Interactive Brokers. Interactive Brokers charges U.S. dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ivkr.com/compare. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business. I'm out of breath.
Are you?
Why?
Are you feeling all right?
That's just a lot. No, I'm feeling okay.
Okay.
Well, I'm in your presence, so take the
So therefore, aw, what a nice guy. But it was a lot. I think you're referring to the fact that that was a lot to get through because there's a lot happening.
That's a lot of stuff.
It's a lot of stuff.
It's a busy day, right?
It is a busy day, and also just this idea of we're back to U.S. exceptionalism, and I almost hate to use that phrase because it's like a little trite, but it's also quite true. And it seems like some of the things put in place during the pandemic has actually wound up helping the U.S. economy continue to grow, which is a head scratcher for the Fed.
Yep, exactly right. The non-farm payroll numbers came in today, just kind of blew everybody away. 303,000 jobs added. The consensus was for 214,000, 275,000 last period. So that's a good number. Unemployment rate ticks down from 3.9% to 3.8%. That's good. Wages are still going up at a reasonable rate, 4.1%. That's pretty good.
What also stands out to me is just that we continue to surprise. Like no economist was like even close to that. Anyway, so you're seeing that upside surprise there in the equity market after that sell-off into the close yesterday. Let's get some more details here. Norma Linda joins us from Bloomberg. All right, you're taking a look at some individual names. You're also looking at the SOX index. That's the chip index. It's up about 0.6%. What is going on there?
Yes, chip makers are marginally higher after a 3% drop yesterday. I'm looking at the SOX index, as you mentioned. AMD is the biggest gainer this morning in that index after tumbling more than 8% yesterday for its biggest decline in nearly a year. Now, I'm also looking at Intel. The Wall Street Journal reported that Samsung is raising chip investments in Texas to about $44 billion. And as we know, Samsung and Intel have been in collaboration for a while. Just back in August, Samsung entered a new product agreement with Intel to continue expansion of their virtualized radio access network. So lots going on in the chip maker space, and we are seeing them pop just marginally this morning.
You're also looking at J&J, medical device M&A, right? $13 billion?
Yes, M&A going on here. J&J shares are about 0.2% lower after agreeing to acquire Shockwave Medical for roughly $13.1 billion. Now, this is in hopes to boost expansion for making medical devices that treat heart disease. J&J will pay $335 a share for Shockwave, and the deal is expected to close by mid-year. And it said that it will fund the deal with cash on hand and debt. I know we'll be hearing from Matt from Bloomberg Intelligence later this this morning rather, but really looking at J&J here.
I get it. Shockwave, right? It helps your heart, shocks
Yep.
your heart. I get that.
Get that.
I get that.
Exactly.
I thought
like
it was that
it.
energy drink. Shockwave.
Isn't that Red Bull? Is there a Shockwave energy? I mean,
It's like
that
a
could also
shock-
jumpstart
Shock
your heart.
Top, I'm thinking.
Shock Top. All
Never
right.
mind.
That's all right. I thought that HubStop yesterday was the ticket
Yeah.
guy. So whatevs. It's all good. And donuts. You're looking at donuts today?
Yes.
Did you bring any?
I wish. See, I love Krispy Kreme. In Virginia, we have them everywhere. I know. But the
Are you
glazed donut.
Is there a thing, like, do people have brand loyalty, Krispy Kreme versus Dunkin'
They
Donuts?
do. It's an extreme rivalry.
Oh, okay. I know.
But
John,
how's
do you-
their coffee? Because Dunkin', you can't
See, that's a
beat.
good question. I don't know.
Yeah.
I don't know.
Dunkin' coffee.
No, I said it's,
Oh,
you can't
okay.
beat
You
Dunkin'
can't- you
coffee.
definitely,
I'm just wondering if Krispy Kreme has a competitive coffee.
No, I don't think it's a competitive.
It's the
coffee
hot and ready
maker.
donuts. Those shares are surging as much as 12%, now climbing about 6%. Piper Sandler called its recently announced partnership with McDonald's a game changer. And it upgraded the stock to overweight from neutral. The company is poised for a much better next couple of years, the analysts are saying, after relatively tough sledding in the past 30 months.
Is there a joke to be made here about like shockwaves and Krispy Kreme and McDonald's? Like I feel like there's a narrative here.
There's another reason why those shares are up.
That's right. That's right. So
That's why healthcare stocks are just always a good long-term play.
I mean, especially now, like
Yes.
just, having older parents, my parents are now 80, and you just see like just how much stuff they need and
I
how
am
much of
not
it is
gonna be that
mostly
person.
free. Everybody says that.
I know.
Paul.
We always say, the way to do it is just not going to the hospital. That's just going to be my plan when the time
Which is
comes.
definitely a choice. Or
When
just
the time comes.
go eat a lot of Krispy Kremes.
Exactly.
And don't go to J&J.
And Samantha's talking about Tim Horton. I've never had Tim Horton's donuts. Have you heard of that?
No, yeah, I have heard of it, but it's not a thing around here.
It's not a thing.
It's not a thing around
John Tucker's making a face, which I assume means he
No,
doesn't
we're
like those
all
donuts.
Dunkin' here and kind of crispy.
I'm the outlier.
Crispy secondary.
And
I'm gonna
the
say
other one is Wawa versus 7-Eleven.
Ooh.
And John's
Yeah.
a big Wawa
I'm
person.
Wawa.
You're Wawa? Okay.
Wawa
She's
is
strong
pretty
opinions.
much become an institution.
It's true.
It's like a religious pilgrimage. People go to Wawa now.
And what's the green one? The Quick Check. That's also the
Quick
big
Check,
investments in
yeah.
Jersey. That's a
But
big one.
Wawa, I think, has like surpassed Quick Check.
But the Quick Check facilities are like massive. I mean, you can get like 1,000 people can get gas there. I mean, they set it up, and I
Which
guess
is
it's all-
nice.
It is.
Yeah.
It's all over. All right, good stuff.
I have a confession before we let you go. I don't
Please.
like donuts.
No surprise. Yeah, right.
No. I love me sugar. Like
Okay.
you give me cake, I will eat it.
But not the
Ice cream.
donuts.
I don't like donuts.
It's not doing it for you.
It's a weird thing for me.
I haven't had a donut since my kids were little. Then you'd have to go. Now I don't
Yeah,
have to.
you don't have to
So
do that
anyway,
anymore.
All right.
All right, I think we're good. Nor, thanks a lot. We appreciate it. You can't top that. Nor Melinda joining us from Bloomberg. All right, let's get another check-in here on where we are in the equity markets. S&P up 0.4%, the Dow up 0.2, and the Nasdaq up 0.7%. Volume is mostly holding up okay. Quite interesting, Paul, as we saw that sell-off yesterday into the close. There was questions as to why we saw it.
I know why I'm blaming Carol Master and Tim Stenevik because
okay.
they cannot hold the market gains that you and I delivered to them every day.
Oh,
It's-
is it their fault?
Yes, it
it's
is.
possible.
Yeah.
They're not here to defend themselves, so I appreciate that.
Exactly.
But kind of knowing why we did that explains also how much we can rebound on this exceptionalism thesis, it seems.
Yeah, exactly. So, I mean, again, today it's all about the labor market and how that dovetails into what the Fed may want to do here. So let's break down those labor non-farm payroll numbers that came in today. Much better than expected. Joni Biley joins us here, Chief Workforce Analyst at EmployBridge. She joins us live here in our Bloomberg Interactive Broker Studio, so that's a good thing. Joni, I guess it's just any way you look at it, a really solid jobs number today. What do you take of it?
Yeah, it definitely exceeded all expectations, across the board. I thought it would be a pretty good job report, but I didn't think it was going to start with a 3 in front of it. When you break down the numbers, though, you will see, obviously, most of this job growth continues to come from the government sector, the healthcare sector, and leisure and hospitality. And so those sectors have really been performing the best over, the last year, certainly even into 2 years. There are some other sectors, though, that are a little bit more challenged, and we're not seeing that growth, come across. And so I'll be looking over the next few months, are we going to start to see growth back in like manufacturing, which was flat? The industry that I'm in is the temporary staffing industry. I'm also the chair of the American Staffing Association. So really look at that sector across the board of what's happening. And that sector hasn't added jobs really in about 2 years. So we've seen decline. So though that headline number is really strong, it's not.
There are things you're thinking about.
Yeah, like when you dig into it,
Yeah.
it's not robust across the board.
It does feel like a lot of the conversation is now centered around immigration and how immigration has actually provided a lot of workers, and that's why we keep growing so strongly. In your research, what do you see in that?
Yeah, I was looking at some of the immigration numbers, and when you look at our overall labor force, immigrants make up about 18% of the labor force.
Has that grown?
It has grown. I think it grew in the early 2000s for many years. The pandemic, of course, everything kind of shut down, but we're starting to see those numbers tick up as well. So the demand there is really, though, for skilled workers.
Yeah. Yeah, so Torsten Slok, who is the chief economist at Apollo Global, he was out with a really cool chart today, right after the data came out. Foreign-born workers contributing to labor force growth, and over the last 2 months, there's been a net decline in native-born workers with this data set, and all of it has come from foreign-born workers. So it certainly is kicking into the labor force. What do you see on this, like in your business, the temporary stuff, and where are you seeing that, and how have the trends changed there?
Yeah, so and it's interesting, I follow his work. Employee Bridge is owned by Apollo, so we look we look closely at his data every morning. I get his emails.
Yep.
But what we see in our business is Employee Bridge really provides staffing for supply chain.
Okay.
So manufacturing, logistics, transportation. We staff a lot in call centers. There has been, certainly a softening in those sectors over the last few years. The hot topic sometimes, in those types of jobs is, of course, we're always focused on placing documented workers, and that is extremely important. But there is a challenge, I think, in some of the lower skilled jobs where you might run into, some employers that aren't following all of the guidelines. But we are seeing demand start to come back in transportation, in logistics, call center, customer service. All of those jobs are coming back, and really strong, still strong wages across the board in those areas.
Do you get the sense that how has employer behavior over the last few years changed, and how has that changed the temp landscape? Because usually maybe you'd lay people off and then get temps back in order to see if the demand was going to be there. Has that now changed a little bit?
Well, I think employers are still wanting flexible workforce. They use temporary labor certainly to ramp up and ramp down. I think it's why we've seen the sector really been hit the hardest over the last 2 years, as employers, when they go to cut back, they don't want to cut their permanent employees. So they will let the temporary workers go first. But right now, we're seeing a lot of optimism. They're talking about hiring and ramping up. And so maybe we really did have that soft landing where now things will start to stabilize, and we'll see that employers will add not only to their permanent payrolls, but also to temporary staffing and flexible workforce models.
Do you see in your work at Employee Bridge, do you see regionality here in terms of the labor market? Is everybody just flocking to Texas and Florida and all that kind of stuff?
Yeah, it's strong, though, also, in the north. Certainly, if you look the automotive, industry, and with the building of all the EV plants, there is a demand, certainly, for workers in manufacturing, even though we're not seeing it in the numbers today. Like, you look at the manufacturing number, and of course,
but
it
the
was
ISM manufacturing was pretty strong.
Right.
That we got earlier in the week.
Yeah, and that was very optimistic. So I think we're going to start to see growth in the manufacturing sector and growth in manufacturing jobs, certainly into this year, but even more so next year and beyond.
Are you based in Florida?
I do live in Florida, but I am a New Yorker at heart.
Okay, I get that.
Yes.
I like to just get a sense of how's the labor market down there? Or, is it just as crazy as the headlines seem to make it believe? Because it seems like here in New York, the story was everybody was flocking down to Florida. even like our big Wall Street folks are heading down there. What's it like to be in South Florida these days?
Yeah, so I do live in South Florida, and there's a strong demand. A lot, of course, in leisure and hospitality.
Right.
You still see restaurants can't find enough workers. They won't even have all of their tables staffed. And there's long wait lines. So the economy certainly is strong. People are moving there. Housing prices are continuing to still rise.
Is that right?
Yes.
Wow. Because, just an anecdote in my town I've shared with these two. A friend of mine owns a restaurant locally here in New Jersey, and for the first time in several years, he now is fully staffed. And he realized, people that bust a table and that wash the dishes, those are undocumented workers. And for the last several years, he hasn't had full hours. But now he's back to fully staffed, so I don't know how that all plays out.
Florida isn't there quite
I know
yet,
Florida's not there.
But maybe they will get there soon.
So what's the next, what's next on your plate? Like, what's the next thing you're looking at and focusing on?
Well, I think, it was great to see the household survey today that we saw the growth in the labor. The size of labor force grew by 479,000. So that, to me, is a number I really watch. I'm always looking at the size of the workforce, labor participation. Do we have more people saying, yes, I want to participate in the workforce? I do believe, though, that employers are going to need to start focusing on training and upskilling workers. That is going to be very important because the jobs are changing so rapidly. We see it with AI, the technology, robotics, in all sectors, not just in supply chain, but in all sectors. And so people are going to need to learn how to work with those skills.
And where do they get work? Are they working hybrid still? That's the thing?
Well, in supply chain, they're back.
They're back.
They really are.
Right.
But in most of the other professional and business service sectors, they're in the office 1 day a week, sometimes fully remote. Really, companies
unless you're in the radio business,
struggling.
then it's pretty much
TV
business.
You guys are here every day.
Yeah.
Yes.
Not that Paul talks about that all the time.
All the
but
time.
if you worked in supply and logistics, you
I know,
too would
I'd be
back,
back.
in the office. So there you go. All right, Joni, thanks a lot. We really appreciate it. So lovely to see you in person. Joni Biley is Chief Workforce Analyst at EmployBridge, joining us here in the studio. Taking a look at these markets here, the idea of U.S. exceptionalism still kind of stand relatively strong. The NASDAQ is up a full 1 percentage point. The S&P is up 0.6%, and the Dow Jones Industrial Average up 0.3%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. U.S. payrolls rising in March for the most in nearly a year. The unemployment rate dropping, pointing to a strong labor market. It's powering the economy right now. So that's pushing expectations for a Fed rate cut from June to September. Treasury yields rising. The S&P 500 pushing higher. You have 7 of the 11 major industry groups in the index. They're up right now, being led by consumer discretionary. And that's where you're going to find shares of Amazon and eBay, both of those up right now. General Electric, the best performing individual stock of the index, surpassing its 52-week high. And then you have shares of Tesla down 1% right now. They're slashing the prices of its best-selling vehicle. That's a bid to clear its biggest ever stockpile. Right now, the S&P 500 up about 30 points. That's a rise of 0.6%. We're at 5176 on the index. The Dow Jones Industrial Average is up 97 points. That's up 0.25% right now at 38,695. The NASDAQ 100 up 155 points. As for yields, the 2-year 4 basis points higher. That's at 469. And the 10-year 3 basis points higher. That is at 434. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. So let's get right to what to do with these markets. At some point, you think that high yields are going to wind up hurting the equity market. That doesn't seem to be the case. We're recouping some of those losses from yesterday. Grace Lee is Senior Portfolio Manager for Columbia Threadneedle, and she joins us now. Grace, when does the 10-year at 4.34% hurt the equity market, for example?
Morning, Alex. Thanks for having me. I think today's news was actually a nice sigh of relief for all the equity market investors who've been pretty much wringing their hands all week on somewhat stronger economic data. But the wage gains were less than, I think, were certainly very healthy, but not anything to be alarmed about. And as far as where rates are, I think the bigger picture is that when you look at what happened in first quarter, you did have rates going up, and you had or bond yields going up, and expectations of rate cuts actually coming down through the quarter, and still the market rallied. So I think we're kind of getting used to that growth is actually okay, and the market can live with that and still power higher and broaden out, which I think is another key point. And so I think it might be a good scenario all around.
Grace, if we are seeing some broadening out in the participation in the equity markets, what sectors would you be looking at outside of whatever the magnificent number is these days?
Well, I think there's a lot of unmagnificent sectors and companies that people are starting to look at a little bit more. And again, going back to what happened in first quarter, it was a revival in things like energy and financials, which I think people would be hard pressed to call those magnificent sectors typically. But if you look at where oil prices are, if you look at just the underperformance in a lot of the financials last year, these have a lot of catch up to play, even after some of the strength in first quarter. So I think looking outside of just technology, which we still like technology, but there are certainly other alternative ways to play those trends, as well as looking at what sectors really haven't participated.
Well, let's go to energy for a second, because there was one narrative yesterday that talked about how the rally in oil, and particularly Brent to $90, was a trigger for the equity market to sell off. Do you buy that? And I mean, do you think that's true? And then also, do you buy energy at these levels here, or do you have to wait for a dip?
Well, we're pretty fully invested in energy right now. And whether it's a positive, I think people are really concerned about whether we'll see much higher gas prices, which could really, drive the inflation fears again. But for now, it seems like everything again is still coexisting peacefully, higher energy prices and still decent growth overall without overheating in the economy.
Grace, we're going to soon shift gears back to earnings mode. We got JP Morgan next Friday, I guess, kicking off some of the really big earnings. What are you going to be looking for this quarter from corporate America?
So I think there's a couple things to be looking for. Again, I think looking at where the economy is broadening out and seeing if that can continue beyond Magnificent Seven, big tech, as well as looking to see if the AI trade does still stay strong. I think you do need a little bit of that to continue for the markets to still be happy, I guess. But then also, for the big banks that start to report, I think there's two things. Obviously, the strength of the consumer. Most of the CEOs have consistently been saying that the consumer is very resilient and that credit trends are still benign. So we'll see if that continues. And then to see what the banks themselves are saying about their interest income trends, given that rates might stay higher for longer, and that might actually be a positive for them.
Okay, so now it's official, guys. Did you guys feel, you're in Boston, Grace, so you didn't feel this, but there was an earthquake, right? There was tremors. It just crossed the Bloomberg. Tremors felt throughout New York City region as buildings shake. We weren't crazy. So we were sitting in the radio studio, Grace, and we're all like, what is that? It felt like we were on some kind of like little roller coaster ride, and apparently it was real. We were not crazy that we thought that.
Well, there's a bucket list thing for me.
Well, we could
There's
still
a
be
bucket
crazy.
list, yeah. Well, both things can be true. It's a bucket list.
Yeah.
Tremors in a building in New York City.
Yep.
Done. Paul crossed that off. All right, Grace, what else are you watching? You mentioned earnings season. How are we positioned here? Like, how is a good way to play it? What else are you looking at?
Well, I think in the consumer sector, there have been a lot of mixed signals recently. Some of the off-cycle earnings reports have been a little bit more cautious and negative. And yet, when you talk to companies, you hear random data points like the auto companies in Detroit saying that they can't make enough six-figure SUVs to keep in stock. There's so much demand out there, or that the cruise lines are seeing people spending $1,000 a day on cabanas, and yet you see pullbacks at places like Olive Garden. So really just trying to understand that dichotomy a little bit better. Maybe it's just consumers prioritizing certain wants over certain needs, or I think they're irrational, and maybe we're just we'll try and make a little bit more sense out of how healthy the consumer is and how much they can continue to keep the economy going.
Grace, how much do you, AI was obviously a huge, huge theme in 2023, continuing into 2024. It's not just NVIDIA, it's broadening out. Is that something you guys at Columbia Threadneedle try to get exposure to? And if so, how have you done it?
Yeah, so across the firm, we've been very focused on this. And, as I focus more on the value and income sectors, I do have to look for more tangential ways to play. So it does fall into old economy technology companies like Dell and IBM, as well as some industrial companies. Let's say a Johnson Controls gets 10 to 15% of their revenue from data centers in terms of building management systems, things like that. Utility companies like Vistra Energy, which has nuclear assets that are unregulated that can really benefit from increases in power prices. So we do look for other ways to play, but certainly a lot of my growth peers within the firm are very bullish on the more traditional AI ways to play. So the NVIDIAs and those types of names.
Yes, that's what I'm saying. The power players. I'm glad you brought that up. That was all the conversation down in Houston a couple weeks ago. That if you need the data centers, you need the chips, you got to have the power, and those power providers, particularly nuclear, really well set up for those data centers. What do you think we're going to hear about margins before we let you go? Because inflation seems to be, sticky, stubborn. Like you picked the word. What do you think the margin conversation is going to be?
Well, I think the margin conversation, I think while inflation is stubborn somewhat, Managements are still very cautious on adding headcount, and have actually, I think you've seen them. You still see announcements of headcount reductions. So I think margins might actually turn out to be okay, and I would expect that we'll see decent earnings beats still with more cautious CFOs.
All right, Grace, thanks so much for joining us. Really appreciate it. Grace Lee, Senior Portfolio Manager, Columbia Threadneedle, joining us from Boston via that Zoom thing. I thought it was just a food cart going across the little divider here.
You didn't feel it?
That's what it felt like. You know,
okay, but it lasted like a little bit.
We're talking about a supposed earthquake that can't hit New York.
No, it wasn't supposed.
Is it real?
I was in there, and I'm just going to bluntly say it. I said, what in the hell is going on? Because the mics were
When
moving.
was this?
This is the official headline crossing
Thank
from
you.
the United States Geological Survey. The records there, a magnitude 4.8 earthquake in New Jersey.
Oh,
Felt by us
Northwest
here
New Jersey.
in Manhattan, and also I think Amy Morris in Washington, D.C. says she was feeling it.
Yeah, the mic started shaking.
Really?
Yeah.
Okay.
John Tucker and I look at each other like, what is happening? Paul's like, what?
I thought it was just a food cart
Oh,
going.
no, Amy says no, she did not feel it, but Jared's mom, one of our employees, mom in New Jersey, felt it lasted for a half a minute or so, she says, according to, this is like hearsay now, but we'll go with what the U.S. Geological Survey says, 4.8 based in New Jersey.
John, let's go Michael Barr, Ward of National News.
Thank you very much, Paul, Alex, John. And we got more news. Israel says 2 senior commanders have been dismissed and another reprimanded after the killings of 7 World Central Kitchen aid workers in Gaza. Hours after President Joe Biden spoke with Prime Minister Netanyahu, Israel announced increasing aid to Palestinians in Gaza. White House National Security Communications Advisor John Kirby says the U.S. and other negotiators are still pushing for a ceasefire.
We want to see those hostages home. We want to see that aid increased, and the way to do that is through an immediate ceasefire, a temporary ceasefire for a matter of weeks.
Kirby spoke on ABC's Good Morning America. Argentina's President Javier Milei has told Bloomberg he won't change existing trade and financial ties his country has with China. The Libertarian leader also talked about presumptive Republican presidential nominee Donald Trump. Milei through an interpreter.
Lo más valioso
The
de lo que ha sido la política de Donald Trump.
greatest value of Donald Trump's policy is that he has rightly identified the enemy, and the enemy is socialism.
Milei spoke to Bloomberg editor-in-chief John Micklethwaite. Hear the full conversation with President Milei on the Bloomberg Talks podcast feed. Get it on Apple, Spotify, or anywhere else you get your podcast. Texas Governor Greg Abbott was in New York City for the Republican State Committee annual gala. Abbott says he has no plans of letting up on busing migrants to New York City, and even boasted he's done more than President Donald Trump on one issue.
When you look at the miles of that border wall that we've already put up and the miles currently under construction, Texas is building more border wall in Texas than Trump built in Texas.
Global news, 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, and the Bloomberg Newsroom. This Bloomberg Business Flash. We're brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. After yesterday's more than 1% sell-off for the major stock averages, stocks higher today. Treasury yields also higher. This comes after a seismic jobs report signaling the U.S. economy will continue to power corporate America. Payrolls swelling by 303,000 in March. So that topped all estimates of the economists surveyed by Bloomberg. This is a jobs report that deserves celebration, according to Mohammed El-Arian at Queen's College, Cambridge.
It is a jobs report that confirms U.S. economic exceptionalism. You're having a strong supply side, strong demand side. So if you look at the economy continues to benefit from the favorable supply shock. If you look at the Fed, that's not going to change much what the Fed is thinking.
And right now, the two-year yield, which is more policy reactive, up 5 basis points. That's at 4.70. The 10-year up 5 basis points. That's at 4.36%. And investors now betting that not June, but looks like more like September for a Fed rate cut if it happens. S&P 500, 33 points higher. That's up 0.7%. 5180 on the index. The Dow Jones Industrial Average up 130 points. That's up 0.3%. The Nasdaq 100 up 158 points. That's a rise of 0.9%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, John Tucker. Apparently, that earthquake that was in Jersey is now downgraded to 4.7 magnitude. But nonetheless, we definitely felt it here. I'm getting all my friends are texting. I have a friend who lives in Jersey who heard like a loud boom and thought it was an arsenal near her house.
That's the Picatinny Arsenal, which is not, which is nearby.
Yeah,
that's a good point. You often get that, but this is near Lebanon, New Jersey, about 3 miles away from that, and that is a absolutely gorgeous area of New Jersey. All of New Jersey is a gorgeous area, I would argue. But
sure, we can go with
and
that. And New York, yeah.
It's not infrequent that you get seismic activity in some of these areas because they're very, mountainous. I'll say like there's a lot of geology out there that lends itself to seismic shifts.
Here I'm getting some reporting in from the Jersey Shore, my palatial estate down there. The whole place shook.
Really?
That's a quote.
Yeah, this is a thing. Apparently, New York Governor Kathy Hochul is assessing possible impact and damage from the quake. We are going to keep you updated on this because this is pretty much all we're going to talk about for the rest of the day. In the meantime, we also want to talk about Argentina. So the Argentine president, Javier Milei, sat down Thursday for an exclusive interview with Bloomberg News editor-in-chief John Micklethwaite at the Casa Rosada in Buenos Aires. Just over after 100 days in office, the libertarian leader discussed his fiscal and monetary plans going forward. Milei begins this portion of the conversation with a focus on inflation.
I don't see why opening up the markets. Actually, what generates inflation is the fact that I haven't yet fully cleansed the central bank. That's the point. If I haven't cleaned up the balance sheets of the central bank, it means that I am not solvent.
If you got rid of controls, there would be a rush to get dollars. There would be inflation would go up. Everyone, I think, would say that.
Well, that's not necessarily what's going on, right? But the thing is this. In order to do that, I first need to clean up the central bank balance sheets. It's important to understand this because when you've got the central bank bankrupt in a situation in which the monetary liabilities exceed the assets held by the central bank, that is corrected through a higher price level so that you dilute your monetary liabilities. The more bankrupt you are, so to speak, the long-term price level is higher. Therefore, given today's price level, the link between those two prices is the implicit inflation rate. As you rebuild the solvency of the central bank, which is what we're doing, consider that the money base has remained virtually unchanged ever since we took office. But still, and despite the put options and the interest-bearing liabilities, what we inherited from the previous government. And after having bought almost $12 billion, what we have sterilized through the purchase of the propelling, and as regards the fiscal surplus, the money base hasn't changed. So we are cleaning up the balance sheets of the central bank, and in so doing, the long-term price level shrinks because we are shrinking the nominal scale in the economy, and the slope is reduced and the inflation rate comes down. This is why it is so important to clean up the balance sheets of the central bank to get rid of that pressure. Once we achieve that and are able to undertake the financial reform in order for there no longer to be the possibility of issuing rediscounting, the financial reform actually has to move towards a free banking system integrated with the capital markets so that there are no runs and all the imbalances are cleaned up through prices. In that context, if you also have your public accounts, government accounts in order, and you don't use the central bank to finance deficit, and if you also lift the currency restrictions, well, the first thing you need to do is clean up the central bank balance sheets. Once we've done that, there's the anti-issuing law. One very key attribute of which is that this will make it a crime against humanity and not time-barred if you issue money. It may well be the case that once we leave office, someone may come along and want to change that. They may do that, but then someone else might come back and lock them up in prison for doing that.
These might all be very admirable reforms, but at the moment, if you're an Argentine living here at the moment, there is short-term pain in the same way as there was with Margaret Thatcher, with all the people who you admire. And I just looked at the statistics. They're quite frightening. The average salary in Argentina is at its lowest level since 2003. 57% of Argentines live in poverty. Consumer spending dropped 23% in February. So far, the interesting thing is your support has stayed high at 50%. But do you accept that there is a time limit on how much pain Argentines can take to take these reforms?
Lo primero es que the first thing is, the way we see it, there has been a cultural change in Argentina. And most Argentines have understood that the solution is not populism. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. When you take the average wage of Argentines back in the 1990s and update it to today's currency, that would be $3,000.
That was Argentine President Javier Milei sitting down in that exclusive interview with our Bloomberg News editor-in-chief, John Micklethwaite. It was so fascinating just to also hear, if you watch the whole interview, his conversation about China and just how China has been so aggressive in investing in countries that have a lot of natural resources and a lot of food, for example, and Argentina being one of them. And you say you want to decouple, and then you get into office and you're like, oh, I can't do that.
Right, exactly.
And there's a great piece on the terminal that really talks about how heavy Chinese influence is there. Even if you don't see it day to day, you can definitely see it in billboards, on buildings. Like, it's definitely more ingrained than one might think.
And you've been to Argentina.
I have.
Right.
A couple times for work, because they have a great...
Huge energy.
They have a huge energy system, but it's they have shale. One of the only other places aside from the U.S. and China that have shale. It's just a matter of actually developing it in a cost-efficient and scalable way.
Are there American companies then, or Western energy companies?
So there were Western companies who were partnering, particularly with YPF, which is the state-owned oil company. But there are problems like export controls and price controls and things that prohibit a free market from working, and that's what you kind of need to draw in the big guys. So the shale area is never truly developed in the way that it maybe could have because of that. But you know, we see. Okay. We see how that goes.
All right, very good. I mean, I'm just looking at WTI crude oil, almost $87 here. I mean,
you can use it.
I could make money in the energy business.
Oh,
isn't the marginal cost of production like $40 or $50 in the U.S.?
$50.
There you go. See, boy, I don't know why we're not drilling more, but who knows? S&P 500 up 0.8%. Strong jobs. This is Bloomberg.
company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. Look at some of the company news we're following. Apple laying off more than 600 employees in California. Part of the decisions to end its car and smartwatch display projects.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Destroyed by the crane collapse, says he is lucky to be alive.
All my airbags went off, and I just looked at myself. I couldn't believe that I was still alive.
The bridge sustained damage, and inspectors will check its structural integrity. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Alex, Paul, John.
All right, thank you much, Michael Barr. So all like the top 5 stories now on
Yes.
the Bloomberg terminal is that earthquake. You have New York City Mayor Adams, through a spokesperson on a post on X, is writing that he's been briefed, no reports on major impact. We are now looking at it back being a 4.8 magnitude earthquake. It was kind of 4.7, 4.8, we're trying to decide. And we're just assessing any kind of damage that may have happened. Now, Mike McKee, he sends a note, and he's like, guys, whatevs. It's no big deal. He says the Taiwan earthquake the other day was 24 times more powerful than the one we just experienced. So to put that into perspective. And that apparently estimated number this year of earthquakes that are in that zone, so about 4.8, 4.7, only causes minor damages and about 500,000 a year.
But we had some, John, we had some reporting from our four-legged correspondent out in western New Jersey.
Okay, again, it was based in Oldwick, New Jersey, which is out there in western New Jersey, in a absolutely beautiful region for those New Jersey haters. I'm not going to mention any names. Oldwick, New Jersey, and we also have some terrific reporting from Pepper the dog.
Yes.
Pepper actually, according to its owner, and the owner is one of our bosses, so I have no doubt I don't doubt this one bit, felt it like 10 minutes before, or at least was acting really weird 10
Apparently
minutes before.
Pepper also is deaf.
Yeah.
So Pepper felt something coming and then apparently ran and hid with the human in the house. So
And my favorite correspondent in Brooklyn, my daughter, she just texted me, she felt it pronounced too. And then on my Fuqua Duke chain, we had some folks out in the New Jersey area, 30 seconds, he said it was going.
Yeah,
rattling, shaking. So
I mean, the good news is we don't have any reports, at least, anybody was hurt or injured.
no.
Good news.
And they're assessing that. Governor Kathy Hochul, at least
But
in
the
New
people
York.
in California are just laughing. We're like, please.
They are. I know, but you're just not expecting it. It's like the things are weird. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to kick it off and get some reporting on that earthquake here in the greater New York City areas. Details begin to come in, so we'll have some of that coming up. Tom Gimbel, he's the founder and CEO at LaSalle Network. He's going to talk to us about this really strong jobs print. It's Friday. That means we talk municipal bonds, and Alex is all fired up. She may leave the studio and go get a snack, but we'll see what we can do here. And then J&J, big M&A trade here, buying Shockwave for $13 billion in that medical device play. We're going to get the Bloomberg Intelligence analyst on to talk about that deal and break it down for us. Right now, let's go to John Tucker and get a Bloomberg Business Flash, John.
And this Bloomberg Business Flash is being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Stocks higher right now. Treasury yields rising. The traders are no longer fully pricing in a Fed rate cut before September. So this comes in the wake of another hot reading on job creation. U.S. payrolls rising in March by the most in nearly a year. The unemployment rate, that held steady. Rick Reeder at BlackRock calls this an impressive report for a number of reasons.
But what you're doing is you're growing the potential of the economy, and if you look at average hourly earnings, they actually didn't go up. So what's happening is you're expanding the workforce, putting a lot of people to work, and actually you're not pressuring wages of any significant magnitude because you're expanding the workforce.
And right now, the S&P 500, 48 points higher. That's up 0.9%. We're at 5195 on the index. The Dow Jones Industrial Average up 207 points. That's up 0.5% right now. And the NASDAQ 100, 233 points higher. That's up 1.3%. Two-year yield, that's up close to 7 basis points. That's at 471. The 10-year yield up 7 basis points. That is at 438. Some individual stock stories to tell you about. Viking Holdings, these are the cruise people. They filed for initial public offering. In this, they've disclosed growing revenue and a loss in 2023 of about $1.9 billion. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
I just want to, there's some actual news that's happening that's not related to the earthquake. Lori Logan from the Fed had some headlines out that is moving the bond market with higher yields, saying that it's much too soon to think about cutting rates and that she sees meaningful risks to continued inflation progress. And she actually said that she's worried that policy may not be as restrictive as assumed. So that's this really follows on, right, to Neil Kashkari yesterday raising the idea of maybe no cuts at all. Now, he's notoriously hawkish, but these are also, this is from prepared remarks too, something that's moving the bond market. The 10-year yield's now up by about 7 basis points.
All right, good stuff. We'll check that out. We did have a 4.7 magnitude tremor near White House Station, New Jersey. That's according to the U.S. Geological Survey. That's the Bloomberg reporting. Brendan Sapienza joins us, Bloomberg Deputy Team Leader for the U.S. International Breaking News. Brandon, what do we have on this? I mean, we don't get earthquakes every day here in the New York metro area. What do we know so far?
So no damage has been reported by New Jersey and New York. Both the governor of New Jersey and New York have been briefed. Mayor Adams has been briefed. And so far, there's nothing to report as far as any catastrophic damage, which is good, especially for New York City with our subways.
Well, how about this? FAA says ground stop at JFK and Newark airports. That's Bloomberg News reporting coming across the terminal. So
it's something.
It's something, I guess.
Now, is New Jersey known for its geological activity?
Well, the last few earthquakes that actually have been felt in New York have centered in the New Jersey, Pennsylvania area. So it's certainly not the most uncommon thing for it to happen there, but just an earthquake in general is a sort of unnatural phenomenon.
See, it is your fault. Told you.
But if my plane is delayed because of a 4.7 little tremor, if I'm sitting on the tarmac in JFK, I'm going to be upset.
If I'm sitting on a tarmac in JFK and I feel the ground rumble, I'm freaking out. Okay, so there's that too. Also, can you put into perspective sort of the reverberations felt in New York? Like, I think that's like the first time I felt like little tremors like over time that were like a couple seconds, but this was very different. I've lived in New York my entire life.
So the epicenter of the earthquake was actually very low in the ground. It was only a kilometer down, which is very unique in the fact that you will feel it more the shallower above ground that it is. And in this case, it was 1 kilometer. They felt it even in Boston. So you could feel it quite far depending on how low on the ground it is. Usually they're much lower, especially in places where it's more common for earthquakes to be felt.
Do you remember, what was the last earthquake that we had in this area on the east? That was the one in Washington, or around Virginia, that closed the Washington Monument, in fact.
Yeah, it was a number of years ago now, at least.
And the National Cathedral also had to be closed because there were,
Did you look that up or did you know this?
No, I know. I was here.
It's fair enough. It's fair
that
enough.
was the last time the building shook. So.
All right, so Brandon, what are the officials saying? Or I mean, do we expect aftershocks or any of that type? I don't know.
Well, you live in California. Yeah. That's why this is like nothing for you.
I'm not
He's
the right
so
person here for this
skeptical.
interview.
He's like, who cares? You guys, suck it up. He's
Hold
that
my
guy.
beer.
But exactly. But what have we heard from, say, the governor, the mayor? Any word from Jersey officials?
So actually, we just got right before I came on. We just got an emergency alert from New York City that residents are still advised to remain indoors. So I guess the possibility of aftershocks is still there. New Jersey activated their state operations emergency management unit. So I guess the possibility is still there. It's unclear, though, for now. But right now, everything seems to be okay.
All right. Also, I think Kathy Hochul was talking that they're going to be assessing the damage. But the FAA is saying ground stop at JFK and Newark airports. I mean, I don't know where LaGuardia is and all of that, but I think we're definitely looking forward to that
Queens.
as well.
This is Queens. We can take it.
All right. I guess that's true. You think Newark would be used to it also.
Exactly.
But again, I just point back to Michael McKee that 2.5 to 5.4 is often felt but only causes minor damage, and that estimated number of them each year is 500,000. So to your point, like maybe we can handle it. Maybe it's okay, Brandon.
Yeah, the thing you have to worry about is a lot of New York City building codes, for good reason, aren't meant to deal with earthquakes because it's just such an uncommon thing. So it'll be interesting to see how the older buildings really hold up with the shaking.
And this is the point about California, is like you guys are prepped for this.
Yes.
Like we're not.
Yes.
It's the same way that like we can do snow, but
Right.
Florida can't. Like it's
Right.
like we're just not used to certain things. So it'll be interesting to see how that shakes out. Yes,
And
John
I
Tucker.
would point out that yesterday's storm had a far bigger impact.
Oh my
in terms
gosh.
of, like down trees,
Oh,
an
yeah.
individual killed in Rye from a falling tree, and power outages as well. So put it all in context.
So we're getting some plenty of weather-related issues here
And
in
then
the
remember
greater
the whole like eclipse thing that's going to happen.
Monday.
Pretty soon the locusts and the frogs will come.
The Yankees pushed their game back from like
right.
2 o'clock to 6 o'clock. The world's just going nuts here. Brandon, thank you very much for joining us. Brandon Sapienza, Bloomberg Deputy Team Leader for U.S. and International Breaking News. And this is certainly breaking news in the greater New York metro area. Also breaking earlier this morning was some pretty darn good jobs numbers coming out. 303,000 additional jobs last month. It's pretty solid. The street was looking for like 217, so really beat expectations. And when we do have jobs data, we like to check in with Tom Gimbel. Tom is a founder and CEO at LaSalle Network. LaSalle Network is one of the largest staffing companies out there, and they have their finger on the pulse of what's happening out there in the labor market. And Tom, I'm gonna guess you're pretty bullish here about the labor market out there. What'd you take away?
It's party time. It's party time. The music hasn't stopped yet. Is the message? Now let's be realistic and say when over 70,000 jobs, right over 20% of the jobs were government, and I think we've always got to be wary of that, and that's been a big part of these positive job gains. Now listen, if it wasn't 300 and it was 230,000, it would still be great.
So Tom, I get it. Like I understand that we got to be careful about the government jobs, but there were others too. And I'm just wondering how you see the mismatch, right? Like, do we have the right people for the right jobs? How do you manage it?
Well, I think there's a challenge. So the big part came in healthcare and in service jobs, and then construction and government. And so I think we all know by the functionality of our government that the qualifications for those jobs aren't very high. So anybody can do those apparently. And then when we look at construction, you need people who are willing to throw hammers and do the blue collar work. And we've got challenges with that. A lot of people don't want to do that. And you get into, the really the validation of where our immigration policies are, both legal and illegal, of how to fill those jobs. And the same thing on the healthcare and the service side. So, what we're not seeing is a lot of white collar jobs in the private sector. And that's a big thing. That's a challenge.
So, Tom, how about the wage increase, about 4.1%? That still seems pretty solid to me. What do you make?
I'm surprised by that. However, at the same time, we're not seeing really inflation decline, and everything's costing more. I mean, we're in the Venn diagram for this will end up going in the Smithsonian because we have a really unique situation where the stock market keeps going strong, unemployment is low, wages are rising, inflation is too high, and at the same time, interest rates are higher than they have been in years upon years, and nothing's stopping this, and that's just a really, really crazy situation that no one has an answer.
But it does raise the question for me that maybe the economy is just stronger than we all think, and that we can add 300, 200, 250,000 jobs. And that doesn't mean that we're overheating. It doesn't mean that the market is super tight, that we're just kind of growing. Is there any truth to that as you see it?
Yeah, listen, the truth is self-evident, so I agree with that. The real problem we have is the ancillary things that funnel that. And what's happening is we've got, why is the service sector and hospitality up? Because more people are traveling. How are people traveling when everything costs more? Because they're spending money and debt's going up. We have the national debt, which keeps increasing, and we have personal debt that keeps on increasing. And that just means we're kicking the can forward, both individually and as a government. I gotta tell you, that's not good. And eventually it's gonna come up and somebody's gonna have to pay the piper, whether it's on the consumer side and the government side. And so that's what's fueling this economy when I see all the service sector jobs being had. So I get even on the construction side, we have If it's home construction that's going on and there's new homes being built, that's because people are buying homes. How do you buy that? You buy that on debt with a mortgage and the financing, and the rates are higher. And how do you do that? And you got to raise wages to pay for that, which fuels inflation. You know, there's some real economic challenges that nobody wants to answer, and we don't have a leader to tell us about it.
It seems like and we're seeing some reporting here from Bloomberg, the black unemployment rate increased to the highest since August of 2022. What do you think's behind that, Tom?
I mean, I think you get into a little bit of the social science on this, but I think in a situation where we have two very different views on society, and I don't mean black versus white, I just mean on what's appropriate. I think you've got people of color who feel that they're left behind. And I think that you have a situation, whether it's right or wrong, due to education and due to job abilities and due to the jobs that they're offered, is that when they're unemployed, is it because they're not getting looks, or is it because they're quitting the workforce or quitting jobs because they're not happy with the roles and what they're doing? And it's something that, you know, we need some help. There needs to be a public-private partnership when we see numbers like that to help change that narrative.
Well, also it feels like we need that when it comes to immigration also. I mean, the surge in immigration, as long as it's legal, could be very helpful to fill some of those jobs that you were talking about. How do you talk about that with companies? What's the conversation around that?
So there's two different types of immigration problems we have in this country. And I think where people want to default to is the southern border, which is a real issue. However, the challenge that's been going on for over a decade is the H-1B visa problem. And that is people that we educate in this country, we send back to other countries. They're college educated. They can't get into the country to do strong white collar jobs, and they go other places and they stimulate other economies where they could be doing that here and filling jobs that we don't have the talent and people to fulfill. So that's number one. Number two is on the illegal immigration issue, is there's the societal impact of what's going on, of the safety concerns, the measles cases in Chicago, and all the different things that are coming up in different cities. But you also have the ability to do the work. And there's just a quiet little secret that people didn't talk about. And that was, as long as illegal immigration was somewhat controlled for the past 50 years, 100 years, we needed that. Not everybody, a lot of people use it for cleaning ladies at the golf courses and the restaurants and the dishwashers. That people came in, it was easier, they didn't have to wait. People like paying people under the table. It didn't contribute to the taxes, but it solved work problems. And now that's gone because there's way too much illegal immigration and it can't be controlled at the southern border. And that creates huge societal conflict. And so we're dealing both with labor issues and societal issues at the same time. And that's why there's all these challenges that exist.
Yep, very good. Tom, really appreciate getting your thoughts here today. Always love checking in with you on Jobs Day. Tom Gimbel there giving us his thoughts here on the strong labor market. Red headline you pointed out, Alex, very interesting. Goes to our friends at Tesla. Scrapping plans for a low-cost car. That's according to Reuters. Boy, if I were to, I'd find it very difficult to be an investor within this company because it just the story whips around all the time. But they were just saying, hey, we're going to come into the market with a lower cost model and drive demand that way. Now, not so much.
And it also apparently will be focusing on developing self-driving robo-taxis, and that stock just taken a big hit. I mean, it's a straight arrow down now by about 5%. And then so let's just say that this headline turns out to be true. Then you have to wonder sort of what's the why behind it. Does that mean that there really isn't the demand for a low-cost car? Or is it more that the input prices are such and it's so hard to lower the cost that they actually can't get that cost down? Or is it a manufacturing issue, meaning that if you're Ford or GM and you're used to having a manufacturing system for cars, will it be easier then to make a lower priced EV? Yep. Those are a couple questions that I have on this headline.
Yeah, I agree too. And I think just for Tesla in general, but then just for the EV story in general, including the ones coming out of Detroit, the question has been, what is that overall end demand for EVs? And I tell you what, people just don't, I don't know. And if I were an investor, I don't think I'd have conviction to say one way or the other. But it appears at this stage that it's just not there. Now, is it a bump in the road that the early adopters, they got their cars, they're all set? and now you just got to work on the economics for everybody else. Is it something like that? And it'll work out over time, i.e. lowering the cost, lowering the price then. I don't know. It's hard to make money, you know, at 80 to 90,000 per unit. How do you make money at $40,000 a unit? That's something that Kevin Tynan at Bloomberg Intelligence has been saying for a long time. Show me how you get to profits on a per unit basis, particularly when I can go make a Ford F-150 and make huge unit profit. And why am I going to do this? Again, so it's going to be a real challenge. But again, Tesla stock is down 4% today on this news, and it's down about 34% year to date.
Yeah, I was like, it didn't need this headline, that's for sure. After being so pummeled so far this year, and that headline coming to us from Reuters, Tesla supposedly scrapping a low-cost car plan and focusing on developing self-driving robo-taxis. As Paul pointed out, that stock down by over 4%. We're going to dig into these headlines, kind of what it means, and extrapolate what we can from it over the next hour as well. Lots more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, it's the data that's in the driver's seat for markets today. blowout jobs report. That signals the economy is just humming along at this point. Treasury yields, they're climbing. Traders paring back bets of a cut in June or July for the Fed. That suggests they see a greater chance of fewer than 3 reductions from the Federal Reserve this year. Meantime, Federal Reserve Bank of Dallas President Lori Logan, she says it's too soon to consider cutting interest rates. And then, as you guys were just reporting, Reuters saying that Tesla is canceling plans for its long-promised inexpensive car. Right now, the S&P 500, you have 10 of the 11 major industry groups. They are higher with communication services and information technology. That spells technology overall. They are in the lead, and the biggest drag right now, that is coming from utilities. The S&P 500, 40 points higher. That's up 0.8%. We're at 5188 on the index. And the Dow Jones Industrial Average, 207 points higher. That's up 0.5%, 38,803. And the NASDAQ 100 up 185 points. That's a rise of 1%. 10-year yield, the benchmark, that's up 6 basis points, 437. The 2-year yield up 6 basis points. Right now, then, it's at 471. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker.
Now on Bloomberg Intelligence, Munis in Focus.
All right. Focus on Munis is brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of building America. Invest in BAM, insured bonds. Boy, what a great time to talk municipal bonds. Eric Kazatsky, Senior Municipal Strategist for Bloomberg Intelligence, calling us from Princeton, New Jersey. Eric, what's new in the municipal bond business?
Wait, did you feel it, Eric? Did you feel it?
Oh my God, did we feel it? We're what, like 15 miles from the epicenter? Yeah, I mean, it was so scary. Ira hasn't even gotten lunch yet. He's been busy looking up Richter scale.
That means he must be scared.
All right, folks,
Ira's not eating.
The folks
Very
on
serious,
the folks
very
on
serious
YouTube,
earthquake.
the folks on YouTube, we had Eric Kazatsky on with us, and sitting right behind Eric is our good friend Ira Jersey, also in Bloomberg Intelligence. Their offices for Bloomberg Intelligence in Princeton, New Jersey, as Eric mentioned, literally like 15 miles away from the epicenter. All right, Eric, so is there municipal bond angle here? I mean, we can start issuing more municipal bonds? I'm half joking, but I felt like I had to go there.
Yeah, no, well, I think the good thing here and the takeaway is that there has never been a municipal bond default because of a natural disaster, earthquakes included. So muni bond investors can rest assured this is going to be a non-issue right now. So that's a good takeaway.
Okay, well, I'm glad we worked that out. So that's
Yes,
quite good.
exactly.
All right. Okay, my favorite question is, how's issuance? What's going on? What did we learn this week?
You know what? Issuance has been quite decent. I think we're up about 30% year over year. Look, tax time tends to be a little bit slower in the municipal market, and I don't think the pop in rates is doing anybody any favors. Any deals that were sort of like waiting to come on the market, they might be held back just to see if rates settle down a little bit. But I think the latest statements by Cash Carry really sort of put a little bit of fear into some investors that we're not going to get any cuts this year. So I do think that's going to be impactful as we get into the fall and closer to the election.
So how are municipal bonds trading relative to treasuries these days?
Most excellent.
Most
By
excellent. There you go.
comparisons,
You like
yeah. I mean, we're outperforming treasuries by 200 basis points.
Wow.
So for those who are just solely focused on total return, it's been a really, really great year. Obviously we're still down a little bit, but you're getting the benefit of that carry in the municipal space. From a yield standpoint, and I think that's really where people should be focused, especially if you're concerned about higher taxes on a comparable basis, right? Tax equivalent yields for those people who are in the highest bracket in New York, you're picking up about 300 basis points over same rated corporates. So, there really is a decent advantage to being in munis right now.
Where have we seen a lot of issuance in the last week? What caught your eye?
Yeah, I mean, there's a lot of stuff on the pipeline that's coming down in the healthcare space, which I think is super interesting, especially because we put out a report yesterday, and like that tie-in right there, where we talked about how some of the biggest passive ETFs don't really have a lot of exposure in higher ed and in hospitals and in healthcare. So, I think that, as margins improve in that space, they are going to be better performing as we get into the later stages of this year and into next year. And those passive products, they're just not going to participate in those returns.
Talk to us about demand out there. If I'm coming out with a municipal bond, nicely rated, what kind of demand am I going to see?
you know what? People are tripping over themselves to buy stuff on the new issue market. Yeah. I mean, everything that's come has been well oversubscribed. You know, California, I think they sold close to like $2.5 billion of bonds. When you get a bond issue of that size, that's that big, that's a lot of bonds for the market to take down. You know, so we did see a little bit of a spread softening with that. But I think, again, as we sort of, you know, get into the higher demand areas of the year, you know, May, June, July, you know, those spreads are going to revert a little bit.
It wasn't there like a thing about sports and Travis Kelce or something wanted to do something with tax increases to pay for the stadium. That didn't work, did it?
Not so much, right? You know, look, I've always been a sort of questioning the fact that, you know, taxpayers are put on the hook or asked to sort of levy themselves to keep their, you know, hometown sports teams, you know, stay put. And no different in Kansas City. They put a referendum out. It was voted down by the, you know, the taxpayers that they didn't want to increase taxes to pay for the stadium. You know, look, at the end of the day, are they really going to uproot the franchise to move? It's a big lift. The logistics are pretty tricky, especially with one that has a deep-seated championship run like they've had in the last couple of years. So I think that the city is probably going to come up with some tax incentives to keep them there. It just might not be on the shoulders of taxpayers.
All right, so what's on the calendar here that Alex should get excited about over the next
I'm excited.
couple of weeks?
Do you hear me engaging with munis? I am working. I brought up sports. You guys are missing all these things I'm bringing to you.
It took me like a year to get Matt Miller engaged, and you're much quicker than that.
And then he left. Right? Yeah, I mean, he was super excited about munis. Look, you know, we go back to sort of those healthcare deals that are coming. They're going to have more spread attached to them. I like deals that I can look at and sort of get into the weeds on the credit and that are just more interesting, right? Look, you can look at a AAA credit that's just like tax backed. It's okay. It's not that interesting from a credit analyst perspective, but things that are revenue based, you know, things that have, you know, had a rough couple years, you know, during the pandemic, like the healthcare sector, I think those are sort of recovery stories that'll be more interesting to sort of pick through.
All right. What else you got? What should I be paying attention? What am I going to get excited about for next week? Tell me.
I think you got to get excited just about how much more yield muni buyers are picking up over corporates. You know, as spreads compress in the corporate sector and muni bonds, you know, will trade softer over the next month as people sell them to pay their taxes. If you're a high net worth person and you're looking to pick up some yield, I think now's the time to be buying.
All right, very good. Mr. Kazatsky, he is our strategist down there in Princeton, kind of this epicenter almost of the earthquake activity in greater New Jersey. Eric Kazatsky, senior municipal strategist for Bloomberg Intelligence. So, you know, it's interesting. You're getting nice yield there on a tax-adjustable basis. I mean, everybody's getting better yield today. I mean, you know, versus the last few years. But on a tax-adjusted basis, if you live in a high-tax state like I do, you know, it makes a big deal. Let's get a little bit more deeper on that Tesla news.
Yeah, let's get to that.
With Craig Trudell. He is our go-to guy at Bloomberg News on the auto biz. Craig, if I were an investor in Tesla, I wouldn't know which way my company's going. First, they tell me they're going to go to the lower end of the market with a lower cost auto. Now maybe they're not doing it. What do you make of today's news coming out of Reuters?
My jaw kind of totally dropped when I read when I saw this headline. I still am sort of having trouble sort of coming to grips with this. It just doesn't make sense.
No, we've said that a lot about this.
But it is crazy because this is, you know, a company that in September 2020 put on an event where Elon Musk talked about this idea of wanting to bring a $25,000 EV to market. And, you know, I don't know if the two of you read Walter Isaacson's biography that published last year, but one of the things that most stood out to me from that book was this idea that, and I quote, Musk repeatedly vetoed, unquote, the idea of actually bringing that car to market that he had, you know, had previously touted. You know, it is so clear and has never been more clear than earlier this week that Tesla desperately needs more affordable EVs. And this idea that they would do away with this product that they really need to bring to market to throw all their chips on self-driving after years of under-delivering on self-driving is just nuts.
So we haven't confirmed that. Let's just be clear. It is a Reuters headline, to your point. But I wondered sort of the why behind it. And I have three options. One, it just pretend it's true for a second. One is that they don't see the demand even for $25,000 car. Two, they can't get that down. They can't get that price down enough to make the margins make sense because supplies are tough and the battery storage is expensive. Or three, they're just not good at manufacturing cars in the same way that a GM or Ford is. Roll the dice. What do you think the answer would be?
I mean, the troubling sort of response to that is like, if it's the case that they can't bring the price down, if it's the case that they can't manufacture, then everything they've been telling investors for the last several years was wrong. That they were misleading everybody. And
okay, so that's probably not it.
So I mean, to me, what it seems like is this is a telltale sign of, one guy calls the shots, and this one guy is extremely erratic and, changes his mind on a whim. And so, the sort of simplest, theory is the likeliest. It's roughly something that Musk himself says. That right. Is what seems to be the case of what's going on here, if you had to ask me to guess.
Yeah. All right, Craig, thanks so much for jumping on with us. Really appreciate it. Craig Trudell, he covers the auto industry out of London. I'll tell you one person who was right on this was Kevin Tynan, Bloomberg Intelligence. He's been saying for years you can't build these things profitably, and until the costs come down, it's just not going to do it. Right now with our news in New York City, here's Michael Barr.
Paul, Alex, John, thank you very much. Officials say an earthquake with a preliminary magnitude of 4.8 shook the New York City area. This morning's quake was centered in Lebanon, New Jersey, about 45 miles west of New York City. These Rutgers students felt the shaking.
We were actually walking the dog, and then we just felt like insane shaking. Yeah. We didn't even process that it was an actual earthquake. We just thought like it was like wind or something. Yeah, we all looked around very, very confused.
The Fire Department of New York says there are no initial reports of any damage. However, the FAA had a ground stop at JFK and Newark airports. That just ended. New York Mayor Eric Adams is expected to speak around noon on the quake, and Bloomberg will carry it live. Governor Kathy Hochul will also speak about the quake. The Israeli military has dismissed 2 officers and reprimanded 3 others for their roles in drone strikes in Gaza that killed 7 aid workers on a food delivery mission. The military said an investigation found the officers mishandled critical information and violated the Army's rules of engagement. The food charity called it an important step, but said a systemic change is needed. Before boarding a plane in Brussels, Secretary of State Antony Blinken said the Biden administration has received the Israeli report and is reviewing it.
It's very important that Israel is taking full responsibility for this incident. It's also important that it appears to be taking steps to hold those responsible accountable. Even more important is making sure that steps are taken going forward to ensure that something like this can never happen again.
Today, President Biden visits Baltimore to get a first-hand look at recovery efforts at the scene of the Francis Scott Key Bridge collapse. Biden will take an aerial tour of the bridge from Marine One. Global news 24 hours a day and whenever you want it. With the Bloomberg News Now, I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg newsroom with this Bloomberg Business Flash. Stock market ending the week on a positive note. After that blowout jobs report signaled the U.S. economy will continue to power corporate America. Payrolls swelling by 303,000 in the month of March. That topped all estimates. Investors now also betting the Fed's going to cut rates not in June but September. But again, the strength of the economy, that seems to be the theme that investors are lashing onto right now. The jobs report giving the Biden administration also something to crow about. Julie Su is the acting labor secretary.
This was another incredible jobs report, right? 303,000 jobs created, bringing the total since President Biden came into office to 15.2 million. Unemployment rate remains at historic lows.
And shares of Tesla right now, they are down 2.2%. They've scrapped plans for a low-cost car that investors have been waiting on to rival Chinese car makers. Of course, this is according to a report from Reuters. And New Brunswick, New Jersey-based Johnson & Johnson agreeing to acquire Shockwave Medical. The price tag there, $13.1 billion. They're trying to bolster their expansion into making medical devices to treat heart disease. Right now, the S&P 500, 55 points higher. That's up 1%. 5202 on the index. The Dow Jones Industrial Average up 298 points. That's up 0.8%. The NASDAQ 100 up 238 points. That is a rise of 1.3%. Two-year yield up 6 basis points, 470. The 10-year up 5 basis points. That is at 436. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. Two things to point out. One, Musk, no surprise, saying that Reuters is lying in reply to a report on these low-cost EVs. So we're going to see how this shakes out.
Okay.
And two, Paul Sweeney now cares about this earthquake.
I do
Want to tell me why?
now about this. Yeah, I go to my New Jersey Transit app.
Only because it affects him.
Only
That's
because
what
it
I'm
affects
saying.
me. Rail service system-wide is subject up to 20-minute delays in both directions due to bridge inspections following an earlier earthquake. All right,
Sorry.
so I guess there really was an earthquake.
There really was an earthquake.
Okay.
4.8,
I live at the beach,
4.7?
but should I be worried about tsunamis?
You're up at like 1,000 feet elevation. You're fine.
Well, apparently JFK flights have resumed based on flight radar 24 data. They were paused at JFK as well as Newark, not LaGuardia. So now JFK is up and running again, arriving and departing at this time. You have hope. You have an hour, right?
Yeah, but I'm just looking at it all standby, standby, standby.
The theme of the day
train's
with
coming.
this, I mean, no reports of any injuries or major, any damage for that matter, but better to be safe than sorry.
That's right.
There we go.
Right.
All right, let's get back to that J&J news that you also mentioned in your business flash. If I can just
I got it
actually
right here.
pull up
So,
that ticker. Oh,
yeah,
fantastic.
Yeah,
You
John
go.
Tucker was just reporting it. Johnson & Johnson, a little bit of an M&A trade here this
That's
morning,
New
Alex.
Brunswick, New Jersey.
New Brunswick,
based.
New Jersey.
They
based.
definitely felt it.
Yeah, actually. Shockwave, interesting name for a medical company, for about $13.1 billion to bolster.
Especially after an earthquake.
Exactly. Bolstering its expansion into making medical devices to treat heart disease. So a nice little trade there. Matt Henderson joins us. He's Bloomberg Intelligence Senior Med Tech Analyst. So, Matt, what'd you make of this deal? $13.1 billion, Johnson & Johnson, heart disease. Tell us what you think.
Yeah, well, I definitely thought this was going to be the only shockwave I was talking about this morning. It's a good deal for J&J on the product side because it's really just expanding out the cardiovascular franchise. They've really gone through a of acquisitions over the last 18 months, really just beefing up that franchise for J. Shockwave is just the next stool in the leg for them.
So what's next? Like, how much money do you think they'll be spending on acquisitions? Like, what's on their roster here?
Well, they mentioned in the call this morning that they're still open to finding the right assets at the right price. They're agnostic for whether it's going to be on the medtech side or on the pharma side. For the time being, this is adding almost $1 billion in sales starting in 2025 when the deal closes. It's growing 20 to 25%. So they're really just focusing on getting this company integrated into their cardiovascular franchise. And then if something pops up and that interests them, that is accretive to growth, accretive to operating margins, which this deal is, they'll back
Okay.
to that.
All right, Matt. Hey, we're going to have to cut it short right there because we're going to go to Governor Hochul. Matt Hendrickson, Bloomberg Intelligence Senior MedTech Analyst on J&J. Let's go right now to Governor Hochul. She's speaking about this
Not
earthquake.
identified any life-threatening situations, but we are certainly asking our local law enforcement and emergency services teams to be on guard for that as well. But again, we are going to be reviewing all potentially vulnerable infrastructure sites throughout the state of New York that is critically important in the aftermath of an event like this. Now, again, I have a few safety tips because New Yorkers are not accustomed to having earthquakes in our state, and everyone should continue to take this seriously. If there is an aftershock, people are encouraged to drop and to cover and to hold on. Drop to the floor, cover your neck, and hold on to something that is sturdy. Take caution near any damaged buildings. Again, we don't have reports of damaged buildings at this time. It is very early in the assessment process, but if there is an after effect, please stay away from buildings, that, especially our high rises. If you hear shifting or any noises, unusual noises, leave your home. Go outside. You are safer there than in a building that could be crumbling around you. Inspect your home for damage. Check walls, floors, doors, windows, staircases. And if you see any damage at all, you may need to relocate while the event is going on. Again, check your own gas lines and water lines to make sure that your family is safe. So stay connected and informed. I will say this, especially with all the national news about what happened in Taiwan with that deadly earthquake just this past week. I think there's a high level of anxiety around earthquakes. The magnitude, which Catherine Garcia and Commissioner Bray will explain, that was a 7.4 magnitude in Taiwan. Again, we are 4.8, and they'll explain the difference. But that's why we're going to continue to take this very seriously and make sure that we continue to update all New Yorkers. So Catherine Garcia, our head of state operations, you'll hear from first, and then Commissioner Jackie Bray, head of Homeland Security.
All right, that was Governor Kathy Hochul, State of New York, just giving us some thoughts and some commentary around this 4.7 magnitude earthquake that was in northwestern New Jersey epicenter.
I
But
think
was
they re-upgraded to 8. 4.8.
4.8, very good.
I
All
think
right,
they
we'll go there,
re-upgraded that.
4.8. So it's there in northwest New Jersey, felt obviously across the metropolitan area at this point in time. Stay away from high rises in Manhattan.
Yeah, ruh-roh. I mean, how do you do that? Maybe in Brooklyn I have a better chance, or out near Queens.
Does that mean I should go home?
Yeah, we all gotta go. Sorry, guys.
But, no, I think,
There's
like,
that.
Be prepared for delays. New Jersey Transit showing some delays there.
Yeah, but just inspect for any cracks, make sure nothing was damaged, etc. So just sort of take a little
What's
extra
the
care.
update at the airports with the ground halts?
JFK is good to go. So JFK is taking off and landing. LaGuardia never stopped, and I don't have any news on Newark.
Okay. So, I mean, but just for New Jersey Transit, believe it or not, those tracks and bridges are like 100 years old. They should be checking.
Oh, yeah,
for
yeah.
cracks.
They
should be
appreciate
checking
that.
them every day,
I
even
think
if
they
there's
do
not an
every day.
earthquake.
Yeah.
And just for some context, this was New York area's strongest earthquake in 140 years.
Ooh,
I didn't
okay.
know that
I did not know
statistic.
that either.
It is now officially the 4.8.
Okay.
It was the strongest since 1884. This is according to the U.S. Geological Survey. So this was definitely something.
Yep.
So we're going to monitor that as well. Also, apparently, the governor in New Jersey and Pennsylvania are all in contact too with each other and emergency managers just to make sure. And airports. Oh, here we go. Airports have resumed operations according to the FAA.
Good. All right, very good. So we'll stay full reporting on that throughout the day. Of course, the biggest one, that's a long time.
It is a long time.
Very
I don't know that either,
interesting.
yeah.
Let's go back just a quick look at the markets. Markets continue to rally here, Alex. The S&P 500 up about 1.2%, 52.08 on the S&P. The Dow up 360 points. That's 0.9%, 38,950. So we're really very much on that 39,000, 40,000 watch there for the Dow. NASDAQ up 1.4%, 223 points, 16,272 on that. Yields also moving higher. The 10-year Treasury is up about almost 6 basis points, 4.36% there. And crude oil, $87 a barrel for WTI crude oil, over 91 dollars a barrel for Brent. That gets your attention.
That would solve some EV problems. But I just want to point out the Tesla stock, watching that, Elon Musk saying that Reuters was lying about a report that Tesla was going to stop making of low-cost EVs and instead go to robo-taxis. So that's still up for debate. And Lori Logan of the Fed coming out much too soon to think about cutting rates. So really pushing that idea off. Markets already looking now maybe a cut in September. Remember when we were going to have 6 this year starting in March? Well, that's a different story. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with a look at some of the company stories we're following. Let's start off with Meta Platforms, of course, the parent company of Facebook and Instagram, changing its policies to allow more AI-generated content to stay up on its sites, even if that content is misleading. The company is going to begin to label, not remove, misleading content that is AI-generated, but doesn't violate any other policies. Now, previously, Meta's manipulated media policy stated that the company would remove videos that had been edited or synthesized in ways that were not apparent to an average person and would likely mislead an average person into thinking somebody in the video had something they did not say. Large accounting firms reevaluating their ownership structures. They're facing growing capital needs and struggling to recruit enough skilled workers, with some considering private equity backing or public listing of the business line. The combination of partner retirements and funding extensive technology investments while spending to attract and retain workers during an accountant shortage has strained some of these firms, according to the Wall Street Journal, and that spurred them to explore